news, earnings, some kind of tip that makes that balanced market go imbalanced, whether it's lower or higher. But then the key point is this price fair price? Is it being accepted or not? And a lot of you guys, well, how do I play the sigmas? All you have to think about it is in terms of acceptance areas, right? So when you're playing sigmas, if you're, let's say, on top of the 2-3 sig, sitting on top, and you're, rejecting the top multiple times, and you're coming under the first sig, well, we've had screenshots in this PowerPoint where it shows you how to play those things, right? So it would be easier to short them. And what I did for you guys, I created almost like, well, I have 3 scenarios, but I'm creating scenarios that they can do and the valid setups for you guys in the sigmas. And we'll get to it as we get through here. But it's really about this piece here. Is the price being accepted? And you guys have heard me say multiple times, like quarterly value area high was at 40.90, I believe. And I said we really have to defend this area if they want to accept the value higher in the future, right? And they defended it and they moved higher. And that's the principles that we use for a lot of setups, whether it's 80% rule, accumulation setups, right? When you think about it, what is an accumulation setup? You're imbalance, back to imbalance, and what do we play? We play to basically accept it and be part of the buyers defending that level. When they defend the level, that means they're accepting it, right? So you guys have to think about it more in terms of acceptance and rejections rather than is it going to bounce here or not. You want to understand where the price comes from and where it could go. Not that you want to predict where it could go, but you have to understand, why is it bouncing where it's bouncing, right? Is there previous buyers that accumulated? Was there a previous important value area? And I think your trading becomes a little bit easier when you think about it in terms of that. I would say that the markets way back, if you think about years back, trading slips and exchanging shares via slips was I would say very slow. And if you guys read some of the books that I recommended, especially the operator book about Jesse Livermore, you guys would see how easy it was to manipulate the stock market before, right? Not submitting the quotes, not submitting the slips, not executing on slips based on the quote and bids on the boards, right? They could do all that. Well, now it's a little bit more automated, so now they have to find different ways, I would say, to manipulate it, right? Lately, they've done an excellent job with the auctions. When we open, you guys see a lot of volatility the first, I would say, 15 minutes, and those are called active auctions, right? Where they're bidding price higher, lower. That's buyers and sellers participating in the auction. When we come out of the gate and we just pump the stock, let's say we open about PDH and we never look back, that was a predetermined, they had a heavy order sitting at a price, they pushed the bid higher and then they continued, right? Those are kind of passive auctions, and they happen a lot, especially now since we've ever added the futures. You have these gaps, right? You create the gaps, but now they're even going to make it harder. We're going to have the VIX the one day, and then we're also going to have a lot more SPX 0DTs are being in the play. And believe it or not, retail does not win 0DTs. They're not made for our traders to make money. They're made for the big boys to take money away from you. When you look at the day, right, and a lot of people forget this, and sometimes you guys will hear me on a bounce, like we've had, I would say, some on Fridays. We also had a few before that on Thursdays. There's different time frame players. Different time frame players have different goals, right? Just like we have a long-term portfolio, right? Some people have a day trading portfolio. Those two are not going to behave the same way. At least they shouldn't. If I'm buying shares for my kid, let's say on AMD at 55, I don't have a reason to sell it at 75 or 80, right? So I'm a long-term buyer at 55, but I'm not a long-term seller at 88. And I would never be a long-term seller at 55 unless I was part of that initial IPO and, introduction of ATM 15, 20 years ago when it was at $2, maybe I would be a long-term seller at 50. But now if the AMD is getting stronger, the fundamentals are stronger, the demands, for the future look stronger. I have no reason to be a long-term seller at 50. So usually, I would say a lot of times, a long-term buyer and long-term seller are not going to cross paths. If they do, something's wrong, right? Most of you guys, when you day trade, you're a day trade model, you're a day time frame trader. You're just looking for a day, fair price within a day, short time frames, and that's where you can use session profiles to determine your movements, right? If you're a day trader and you're looking at weekly and monthly profiles, you will not have a lot of trades, because by the time it gets to your levels, you're just going to be bored. It will require a lot more patience. A long time player, right? And you, when they come in, you feel it, right? You feel it with volume, and you feel it with the type of reaction it gets to a certain level. And we've seen it before, when we trading live, we've seen it on the charts. They come in and it's like, man, somebody had a lot of resting orders sitting here, and those limit orders get picked up and they become market orders. And then, you have the retail that come in the day, maybe not retail, but daytime traders, and they're like, oh, wow, look, it's moving up, making higher highs, volume's picking up. What do? They jump in and drive the price higher. The market orders are the ones that move the price. The limit orders, they're just resting. They're not really participating, and their anxiety level is fairly low. So let's cover next slide. So I think I covered some of this already. Yeah, anxiety level for short time frame participant ranges from active to passive. So a lot of you guys are fairly in there. You're pent up. You're looking for action. Anxiety level from long-term traders, if you think about it, goes from passive to active. They don't see a lot of action until it becomes to their level, and then it's like, oh, here it comes, and then they get involved, right? And when you think about the volume, right, participants on short-term time frames usually are the most active, and they make up a lot of volume during the day. So when I say there's an absorption happening or this, it's just that there's a lot of retail guys. When you think about it, let's say there's 5 million traders and they're all looking at, there's a lot more, but let's say they're looking at different stocks and they're buying AMD at 95. Well, if somebody loaded up at 50, a midterm trader, and they're looking to offload at 95, so now these people are providing liquidity for the long-term seller or a midterm seller at 95. So that's how you have to kind of start thinking about, right? Where was the price? Was it accumulated? How heavy was the accumulation? And could it be that there's an exhaustion coming up here? Because a true long-term buyer is not going to be buying stocks that went up 100% from their lows. Usually they don't do that. Okay. I think we covered this, right? Long time frame buyer will not be attractive to long time frame seller. If these were the only two buyers or type of buyers and sellers in the market, what will happen to the stocks? We wouldn't have any volume. They wouldn't be moving much. You need volume and price discovery. Price needs to move and fluctuate, right? So that's why you get these short-term people bidding up or down, right? To make sure that it gets to a level for selling and that it gets to level to a buying. Everybody hear me? Just making sure that I'm not off.
Yes, Shorty, we
Shorty.
can hear you.
Yes, we hear you.
Okay. So if the market only existed of these long-term buyers and sellers, I mean, this it would be a miserable market to trade. Imagine you go to a Saturday market for fruits and veggies in your little city, and the guy's selling oranges at $20 and the guy's offering $2 for oranges. Well, those oranges are not going anywhere, right? I mean, they're going to go get spoiled, right? I mean, they're going to be bad. because this guy is not budging or reducing the price. This guy's not increasing the bid. Therefore, the orange is just going to sit there. And it's the same with the price. If there is no agreement between the spread and not many buyers and sellers in between, then we're just going to be stuck. And sometimes when that happens, that leads to a dual tape, and then you guys see a reaction in the market. I think this picture here summarizes pretty much the three components that we should care about the most, which creates value: time, price, and volume. I would say is the combination that brings you the stock market, the auction theory, right? And a lot of people just look at time in terms of, oh yeah, we open and we close, but there's a lot more to it, right? There's time, price, opportunity. That's your market profile. It sets up the market, right? I mean, and you hear sometimes when we're trading live at like 350, trading at those times is very, very risky, just because a single move can, kill you, but you can also make money. And if you understand a little bit of markets, hopefully your odds of making more money are good, but they can also wipe you, just because the time, how much time you have left and the opportunity is lower. And then of course price is going to fluctuate, but then also volume can go both ways. It can spike towards the end of the day as people are closing their positions or buying for the next day, depending on what they know. Basically your time here regulates the market, right? And this applies, I would say, to everything you guys do in life, right? The only thing you can't buy is time. You can't go back. So whatever you guys are doing, think about the time, right? And you guys know that I'm fairly big on buying back time, meaning if you're done trading and make some money, you just leave the charts. Your job is not to spend more time for the same amount of money, right? And you think about yourself, if you did like plumbing. If you finished a job at the house in an hour and charged $1,500, would you sit for another 7 hours at the same house? Most likely you would not, right? You would move on and look for another opportunity somewhere. If you can, fix something else or have other clients, you would move on. Uh, and maybe you just go home after that as well. And that's for you guys as well. When you're trading, you make your profit. Even guys, $400 a day is a lot of money. And some of you guys just don't want to accept that, right? But you will once market will teach you. Then you're going to be very, very humble, and you're going to start taking those profits and kind of compounding, accumulating wealth. Okay. Uh, so the bottom bullet, the price market discovers new levels. Time consumption suggests that there's some acceptance in that new area. And finally, the volume generation confirms the participants have created a new value zone where they trade comfortably. Can everybody visualize this all in one? How it would look? If you're in balance and you pop there and you spend a lot of time in that area, that means you're creating a new value, right? That means people are happy to trade there. Time spent is there. That means volume profile would also look like there's a lot of volume there. And if they defend the previous value area high, that means it's acceptance, right? The same thing we covered in the first slide just moments ago, correct? So now you can hopefully see the three pieces kind of go together, right? The price, time, and volume. The volume is usually the key for confirming whether they're gonna stay there or not. And we do pay a lot of attention to volume in the Discord just to make sure, because that's the only weapon that you have against the big boys. They can't hide volume, even though they do their best, to camouflage their entries, to throw the bones via option flow to you guys, and people bite for it, and then you see a reverse, like, oh my god, they lost money here. They were never intended to make money on that option. It was just to get out, create liquidity for exit. They buy a lot of calls on Amazon for 110. What do you think other people do? They probably follow that Amazon order and buy it, and as the price moves up, right, they're looking to exit their shares, and they spent a couple of $1 million in options, but they're exiting, let's say, $300 million worth of shares at that price. That's a win-win. They risk 3 million. They increase the price from, let's say, 100 to 110. Well, they got $10 more per share on, let's say, 100,000 shares. Well, that's a good win for them. And people don't really think about it sometimes like that. And that's why I personally don't care too much for the flow. It could be said that the flow can drive the market, but there's still big money that doesn't play with options, right? So, okay. I think we covered this pretty well. This is your, it's not only it opens at 9:30, it closes at 4. You have to understand that time works against you as you're in the market, right? It regulates the market, but it can work against you if you don't understand it. If we are accumulating at a certain spot for a long time, and the volume profile doesn't show that there's a lot of volume spent there, and we go higher, well, to me, that's kind of like iffy, right? You spent a lot of time, but you didn't have a lot of volume spent, but you decided to go higher. And then when you break that accumulation, when you go down, that becomes an instant confirmation to me that it was a fake trap for longs, right? You spent a lot of time, you accumulated, volume did not agree, you went up. Now, when you break it, it really, really becomes important when you're shorting right below that level, because it was meant to be shorted and they just set up a trap for longs. Okay. Any questions on time? No?
No, sir.
Okay. Who has an example, I would say, on price? Like if we were to talk about price, I want to make sure that you guys, we covered an example before, but what's the best example you have of time and price? A real life example, anyone? How does the time regulate the price? Sunflower.
An example
Or-
could be like skiing. During the skiing months, the stuff is more expensive. Your skis, your snowboards, all that's more expensive during that time. Whereas summer, they're going to be on sale.
Yep.
Something like
And if you miss the sale, what happens?
you lost money, or you have to buy it at their retail prices or wait.
The premium price, right?
Yep. Goes
Yep,
up.
no, that's correct. We talked about skis before, but it's in everyday life as well. I don't know where you guys live, but let's say if you have a Publix next to you and there's a weekly ad and you've been waiting to buy, I don't know, like let's say some kind of special butter, and it's on sale from $8 to 4. Well, if you don't react within that week or that period when the ad's available, that's your time regulating opportunity. If you don't snatch it, well, next week you go buy and you're going to buy that butter at a premium, no longer a discount. Does that make sense? Is that everybody can kind of compare themselves to that? Same thing happened for your shoes. You guys see oil changes, specials, right? Hey, only today, $19.99, 5-minute oil change. Well, great opportunity. You might not have a car after a while, but you have a day to catch that right deal. So there is, a balance between time, price, and then value. And the last component, time, price, volume, and that creates the value. If you see, let's say, talk about the oil opportunity, right? And you see a huge sign, and you go get the oil change, right? After 30 days, you notice something's off in your car, making weird noises. The next time that you pass by, there's a similar sale at that place, but half the price that you paid. Would you find that valuable?
No,
Why not?
because they messed up the last time.
Yeah. So you have to remember how the price and how the value was last time so you don't buy crap. And the market works the same way, right? If we are at the bottom of a value last time, and let's say we did not get a strong bounce there, and you're revisiting that value area, bottom of it again, well, the odds of you catching a good deal in a spike might not be there. That's where you start looking into the change of character, right? Where, hey, has it made a higher high? Has it swept the liquidity from the left? Like, what are they really trying to do? That's where the time and the price become really, really important when creating value. And hopefully it makes sense, but it's super important that you guys understand the three components, the time, price, why is it valuable, right? The volume is the one that confirms the price and where it's at. The time is just there to regulate it. If you miss the boat, like somebody just said, you missed it. You might have to pay the premium for it. If you miss buying, let's say Tesla at 100 and it went to 200, well, you're gonna have to pay 100% more than what you could last time. So that's literally how the stock market works. But it could be that you find value at 150 now because you didn't want to buy it at 200, and now it's coming back to 150. People will find value there because it's half off from where it was, right? So you have to think about, the value and the perspective of different. You don't care about yourself so much. When you're buying stuff like that, you really don't think about yourself. You're thinking about what are the other people, institutional doing there. Because you want to be flowing with them. You don't want to be flowing against them as much. So that's the key to think about. Hey, could there be other time frame sellers, buyers here? Yeah, just look at the value areas that you have on the longer periods and see if something matches. If something matches at that point, then maybe you join them. Let's say it's a 2-month value area high. We popped. We're coming for a retest. I would assume that they're going to be there. Somebody's going to be there protecting that balance and making sure it's accepted. You get in, you get a little piece of pie there, and you get out. Well, most of you make mistake is that you get in that level. Sometimes you don't put a plan on how you want to play it, meaning exit and stop loss, and then you turn to God and hoping. And when you do that, that's when it's troubling. Then you start going on Google and looking for everything that's in your favor on why it should work, and then you create like an illusion that's going to get there, and that becomes painful as you watch your account almost bleed. Let's say you put in $100,000 and it just bleeds and you don't know how to react. It's almost like you're frozen, right? And I know some of you guys have experienced that, but that's the brutality of the market. It takes your money sometimes fast, but sometimes it does it and your hands are almost like frozen. You can't click, you can't do anything because you justified in your brain the rational thoughts that it's going to work somehow, right? And that's where you have to stop. If the value is no longer there, the volume doesn't approve it, just get out, right? Have a good plan and get the hell out of it. Okay. This is fairly simple concept, right? So there's really never more buyers or sellers in the market. For every share you buy, there must be somebody on the other side that's willing to sell. It's just funny when you see a lot of these people on Twitter and experts talk about supply and demand, and they're like, yeah, there's a lot more buyers at this level than sellers. To me, it's fairly funny because I can't even visualize it, and I don't even know how to visualize that. So it's just, to me, it's pure stupidity, and I don't know how they ever, got in. Who taught them that in the market, and if they've ever like actually been and talked to like a really hedge fund trader or a portfolio manager. I think that would be the joke of the office, right? Like at the office, oh yeah, there's more buyers here. I think he'll be fired or she would be fired fairly quickly if they ever said that in that environment. So I just don't get it. And to me, it's usually the aggressiveness that drives it. If you come to a level and the market orders are flying in on the buy side, so think about it. We did this last time when I offered $20, right? Auction. I don't know. Was anyone here that was not there on a call? Was anyone there when we auctioned $20 bill? Just say yes, no.
Yep.
You were
I
there.
was not there, Shorty. I
Yeah.
was not.
Was there anyone that wasn't there?
Yes.
I was not there, Shorty.
Okay. So I offered $1 bill at an auction, and we can do it again. I'll give you here. I'll give you guys $100 bill.
I'll take it for 90.
Okay, 91.
I'll still take it.
93.
I'll take it.
Still take it.
95. I'll
Still
put a
take it.
signature on the $100 bill. 96.
I'll pay 100.
For your signature, 200, Shorty.
100 and a quarter.
Nope.
I'll pay.
110. And you see how quickly the room gets quiet, right? When there's no value, the buyers disappear. For me, as a seller, if I see that there's people willing to buy at 110, what should I do? I should take all the hundreds and give them to you guys.
Hold it.
No, if I see that you guys are willing to buy at 110, that there's people bidding at 110, and I know the true value of that is 100, sell it.
Yeah, I meant like hold it till you get to 110, then sell it.
Yeah, I should sell it as much as I can, right? I should offload all the hundreds and Benjamins I have in my pocket to you guys at 110. And then when I no longer have any hundreds, what should I say? Oh, these dollars are horrible. They're bad currency, right? And then you guys freak out and you sell it back to me at 70. I buy it at 70 and then I say, hey man, the dollar is really good. Let me drop it back to 100 and you buy it at 100 again.
That's wrong.
It's not wrong. That's exactly what happens in the stock market.
I know. Good morning.
I gave you guys the example of the monkeys, remember? Where there was a guy, he would buy up all the monkeys from the village.
Yeah.
He started off offering $3, $5 for the monkeys, and people would just bring all the monkeys. Once the supply of the monkeys, dried up, well, the guy leaves the city and puts his assistant in charge. And he said, yeah, he went out of the town, but he said he'll be buying monkeys once he's back at a $50, $75 range. I can sell them to you at 35. And what do the poor people do? They buy the monkeys at 35.
They gathered all their money.
They buy the monkeys at 35, and the average cost for the guy that had the monkey was probably like $7, $8. Well, they never see the assistant or the guy. They just walked away with profits. And now the people got the monkeys that were usually free and cheap. They got them at 35. So those are the candle holders in the market, right? Those are the people that buy, upstart at $400 and they're still praying to some sort of gods, or I don't even know who you can pray to, that it comes back to 400. And it's the same type here, right? It's the aggressiveness that drove it. They exited a long time ago, right? They created greed at the top. They made people think upstart is gonna do, I don't know, and then they asked that the top hedge fund people, yeah, this is a great stock, and then you ask them what did they do, and he's like, I don't know, but it's a good stock. So who do you think had a lot of that stock when they were at the top? It was probably that same guy that offloaded on the retail. The same guy that said that it was a good stock. Now think about it, the monkey example, it's the same shit, just a different analogy. Hey, this stock is great, man. I see a lot of potential. Hey, but why is it good? What do they do? Well, let me tell you about the weather. It looks really sunny today. and they do that a lot, guys. I mean, you're a famous guy, Jim Cramer. I mean, I honestly personally think he's the puppet of the big boys to create liquidity for them.
Wow.
He made a name. They figured how to use him. They pay him under the table, and he gets his subscriptions. Sometimes he nails the good ones, and it's almost like those little things that I told you guys about. The gambling, the little dice, and sometimes they let you win, and then the people start believing Cramer. And what does that do? Oh, it's like, oh damn, Jim Cramer was right. Oh, Jim Cramer was right again. He was right. And what do people do when Jim Cramer writes the next time? Oh, they get in, but the dice is no longer there.
Yeah.
And then you get fucking slaughtered. And that happens a lot, guys. I strongly believe, I believe and I know that there's setups like that, right? You see them in the news, HSBC upgraded NVIDIA to 340, and they were the only downgrade until yesterday. I'm sorry, but what changed in NVIDIA Is it the demand that changed? It could be, right? I mean, they have good stuff, but hold on, their inventory is up 100% year over year. What about the cost, the carrying cost, the aging? I mean, there's so much to it. It's like, okay, well, don't you want them to liquidate that first before you upgrade them? Like, don't you want to see the margins after that takes a hit? We just saw Tesla, right? Before earnings, what did I say I was going to do with Tesla? Did I say I'm going to short the crap out of it? I wasn't even looking at the price. I said I'm going to short it. If you struggled in Q4 to keep your margins high, and then you had that, fire sale one time, 2 times, and you still haven't sold all your vehicles, what does that mean? Demand's slowing down even when you lower the price, but when you sell those cars now, you're not making money. Of course, Tesla still makes more money comparable to other cars, but it's also valued differently. It's not valued as a car manufacturer, it's valued as a tech company. So if that's the case, how many more hits to the margin can you take before you just become another car manufacturer? And to me,
But
that was an example that I played.
Shorty, how did you know before the earnings that they still had stock?
They still had stock.
You meant you shorted them because you said even they had inventory. You said I shorted them because they had inventory, even though they did these flash sales. But how did you know that they had the inventory if it was before the
They had
ER?
the Q4 earnings, right? On the last
Yeah.
earnings report, their inventory has not moved drastically. They still had inventory available. So if you had inventory available and then you did a bunch of sales, and then, they do have releases on the sales in China and, production in China. When you look at them, it's like, okay, you're producing, but you're not selling. So, and even if you have these sales and you're not selling, I think it makes, how do I put this in? I would say a lot of buyers that have Tesla now, those are the fanboys, and they will have Tesla, right? Until Tesla does not treat them right. So if you had a Tesla, you bought it, what's this? I don't know. When was the first Tesla release? Was it more than 10 years ago or no? I really don't know. They say the typical battery life is 10 to 15 years, right?
Sí, caliéntamelo
Hold
y
on,
déjamelo ahí,
Cuban,
porque no, ahora no, me lo como un poquito más tarde.
Cuban, you got a hot mic.
So I'm just saying Tesla is going to enter the phase where all these cars are potentially going to have issues. How Tesla is going to treat those initial buyers that made Tesla who they are is going to set the stage for the rest of them. Because if those fanboys are not rebuying the Teslas, and they can be the word of the selling point. I mean, I had the Tesla, but once the bill came in for 20K for the battery, I just couldn't. And you're just gonna have Teslas laying around, right? And when you leave that, what happens? Well, Tesla has to have either really good marketing strategy coming up soon, or it's just gonna be another dumpster stock that went super high and then it didn't create much. And I'm not saying that's gonna happen.
Hey.
Oh, dumpster. I'm not saying it's going to happen, but they're on a path, right? Then, Elon had this plan all along, start selling really expensive cars to be able to afford to sell cheaper cars, right? And maybe that's the plan that will work out, but just how many people are going to be butthurt, from their experience initially. And, too far into Tesla stock, but yeah, I think in a couple of years, it might be coming to a level where it's desirable, but not at the moment. Tape, if you guys want, we can cover this. Most of you guys should be up to date on how to look at the tape, diagonal looks, if there's more selling, if there's more bid than the ask side, higher chance the price is going to move up. If there's a lot of sells on the other side on the ask there and the bid is fairly weak, we're just going to flush to the level where the next level where the people are going to be able to absorb all the selling. Okay. It got stuck a little bit more. So if you look here, how to spot exhaustion on the tape. Usually there's an imbalance between the orders. Some of you guys use the heat map on ES. Some of you guys have the actual delta divergences, and some of you guys have the the footprint charts, right? The footprint charts are probably the best to show, whether it's a 30-minute chart or 30-minute candle footprint. You can spot that on certain candles, and I think the only one that offers it right now is Ninja and Sierra chart. I don't think TradingView has it. Maybe I'm wrong, but I haven't seen it. So you'll be able to spot these fairly easily when you see it. And usually, just whoever doesn't know, what we see is level 2. If you want to see level 3 and more orders, right, that can be also very deceiving because of the ghost orders. But you can see where the supply and demands are based on the level 3, right? You'll be able to see a lot of orders lined up. And when they are there, right, doesn't mean they will react there, because if something changed in the environment, they can kind of remove the orders. And then if you buy at a level where you saw a lot of orders sitting and they're gone, well, it was just a ghost order to get you to buy there. Okay. We talked about this. Okay, so volume profile, I think most of you guys should get an idea of volume profile by now, right? So it is the horizontal volume bars versus the vertical, which what most people are used to, right? Is seeing at what time was their volume, not at what level was their volume. And a lot of people, when they get into trading, they see these horizontal bars and they pretty much get scared and don't ever look at it again. For me, it was really intriguing way back that you can actually see at what price did the volume occur, right? So from there, I was like, okay, well, this can be really important, because if you consider volume as the confirmation of stuff, then hold on one second. Let me just close the doors here. Unless you guys want to watch Bluey with me. And when you have the ability to see volume at a level, right, it's very important that we note it, right? And that's those shelves that we see. We had an example, was it 4070 on Wednesday, where we shorted that. And I mean, it was a large shelf that was created, the Dumpsty missed. And we anticipated that move, right? It was where the market dumped from, and that's where it came back to revisit, and it was a good short. So market has a really good short-term memory. If you have to go back past 30 days on volume profile, you're looking at different time frame buyers and sellers. And that's where you have to be thinking, I can't get in here. I can get in here, but I have to be quick if I'm scalping, because I'll get a reaction. But if I don't, then I'm mistiming my entries, because if it's a long time frame level or a shelf, you can't expect it to work out in a day. Just as if you were grabbing fibs from, let's say, all-time high to low, I can't expect, the 61.8 from all-time high to October low at 300 and 4309 to be hit tomorrow. It will need to run a lot, right? So if I'm waiting on those fibs, I can't use them for day trading. I would need a shorter swing, high and low, or low to high, to find the levels where it can bounce. So the same with volume profile. If you're using a shelf that's from 2020, the odds of it coming to that level, are low. But then if it comes there, you can't expect to play that and then it plays out immediately for you. You need to buy time. So the longer the period on the volume profile, the more time you have to buy as well. And that applies to the sigmas, to everything, right? So let's see. I think you guys know the layout of this. We cover this right now. Many people call it really advanced order flow indicator, because it does tell you the orders and where the price action happened. Don't be like Dumpsty and think of volume like in your car. That's not the same volume we're talking about. It's slightly different. Okay. When you look at volume, right, it's made up, volume profile, that is, it's made up of different components, right? The most important one that you should be aware is the POC. That's where the price is really fair. And that's where the dealers love when you're there, the locals, because they're going to make a lot of transactions. You're going to be trading there a lot. Therefore, the bids and the ask get a little tighter, but that means also they're grabbing a lot of transactions. I use POC as a sentiment, and you guys have seen me even on the rules for Shorty volume profile. You know, if you're a day trader and you're breaking PD POC, you know, the sentiment slowly shifts to bullish, right? If you're breaking value area high, that means you're not accepting the previous day value area and you want higher in this case. Then you just got to find where's your exit, you know, once you reach a certain point, because it seems like you're creating an imbalance, right? Those are the things that I pay attention to. So the POC is really, really important, right? While we're speaking about POCs, there's something called naked POC or virgin POC. Those are the POCs that haven't been retested, meaning the price never fell to them. And they're fairly, fairly important. You know, whether you're using weekly or monthly or daily VPOCs, they're fairly important to your trading. You will most of the time get a reaction from the VPOCs or naked POCs as the price arrives there. Okay. Let's see, high volume nodes. So this is when you look at the rest of the profile, I mean, we've spent a lot of time on those. You will see high volume nodes like a little large shelf sticking out. It's still not the largest one. The largest one would be the POC. The POC in itself is a large volume node. But high volume nodes means that if they're smaller than POC, but they still had a lot of potential, then usually happens when the price was either rejected from that level or if it got accepted somewhere else. If it got rejected from a high volume node and went and created a POC above that, that means that node before that was used as an accumulation and they did not feel like the value was fair there, so they seeked higher. And now if you go and create a POC and you're above that, right, and you're creating more value and more volume is being shown there, then it looks like that you're most likely going to run. And usually when you see P-shaped volume profiles, you see, you know, skinny bottoms, right? You see a tail, and then you see at the top, you see a POC. There was not a lot of value found on the bottom, so they quickly drove the price higher, and now they're accumulating for the next move. If it's rejected, most likely you're going to lose that value area of that area, right? And then you look to see if there's a volume node where it bounced from, and that's how you can kind of justify high volume nodes playing as a support or resistance. Low volume node, that's your low liquidity area. There's not much being there, right? And then we'll show you an example of it, but there's nothing being done there. It means price is just going to go through it. And a lot of you guys actually trade using the low volume nodes. As you enter that, you know, you can quickly catch on ES 10, 15 points if you're patient. If there's a skinny belly, as we call it, the price can just literally fall through it because there's no really active auction in that area. Price is just going to go to the next level where there are orders sitting. Okay. This is, I guess, the bread and butter of pretty much all of the volume profile and trading is the bell curve, right? So if you guys think about it, you know, we've covered this a lot. We started with 68. This is your first standard deviation. Then we added the 95.7, which is your second. And then you have the third, which is 99.7. And a lot of you guys at first were a little bit confused on this, but it's fairly simple, right? When you're on the extremes of a bell curve, there's a high chance that you're going to be returning to the mean, right? The zero standard deviation. Once you come back to that, you can use this to kind of create your plays. And how do you want to play this, right? And you guys have, by now, you should see the 2 sigma and 3 sigmas work pretty well in terms of, you know, respecting the levels when you're rejecting 2, 3 sigma, or if you're in the bottom, buying them, right? You don't necessarily just short the top blindly. You need some kind of confirmation, whether it's a lower low or, you know, lower highs. And same is true for the opposite side, but it really becomes powerful when you're trading within value and standard deviations, because they also use that and they like to buy when the value is there versus when it's not. 1 second, please. Sorry, guys. This is in the PowerPoint, so I did put a video together for you guys to really explain the sigmas and, you know, how do you form them, how do you create them. So, for the people in Discord, you guys will be able to watch this. The covers, the Sigmas, a little bit more detail, right? And you guys will be able to kind of replay it as you want. I'm not going to play the video right now. You guys can do that on your own time, but definitely suggest that you guys watch this video and play it and see if it kind of makes sense for you guys when you put all of these pieces together. Let me go here. So what I did here for people that are watching from YouTube and for you guys is how do you find this in the simple steps. So finding consolidations, usually when you want to find, it doesn't mean it's always a consolidation. Especially now we've been consolidating since I say since last year, right? We're still in balance for last year, so that's a big consolidation. If you want to look at that as a really big consolidation, sure, you can. You just grab from April to April, 12 months trailing, and you can find your zones and you mark them. But remember, that's a 12 months worth of data. That's fairly, I would say, large data set, and you have to play it in such way. You can't play that and buy, a daily contract and expect it to reach first to second sigma in a day, because those areas are going to be fairly large, right? Apart. You got to accommodate by buying more time when you're trading, if you're trading options, or even if you're trading futures. Probability of those levels hitting, in a day are very low. Okay, I'll give you guys a second to read this and let me know if it makes sense. Most of you, I would say all of you, should be familiar with how to do this. Dempsey, I had nothing better, but I found your picture here, man.
Looks like it makes sense.
Yeah, it makes sense.
Okay. Here's the example that we just had. And if you guys look closely, I mean, the price is really respecting all the ideas that we teach, right? You peak about second sig here. I didn't mark the third sig, but it was somewhere around here. You reject it, you come back under it, then you go to the next sig, you go below it, you come back for a retest, you come back to the POC, and let's say now you're accumulating at this 41.53. Where did the price spend a lot of time here? If you look at it, spent a lot of time below the CPOC, and every time we went up, what happened? They rejected it, and the POC shifted. If you guys recall, it was building around 30s, right? Then it built at 40s, and now it's building at 50s. So the POC shifted from 30s to 40s to 50s, and if the price is staying below it, right? What would you guys think that is?
A signal that they can go and go lower.
Yeah, there's a signal that they might go lower. So they shifted it, and now they're trying to maybe close it. But if we break the structure, right? If they, it depends what time frame we're on. I don't know which time frame this was. But if you break the, let's say you change the character and you make a higher high and you retest, it might be idea that they really accumulated and they want to go higher. For me, right, it would have to be that they break the first sigma and we hold it, right? They tried holding that, they broke above it. They tried holding here, but they never took out that high. So, it invalidates it. The idea behind the sigmas is that anytime the stock is consolidating like this and you're reaching the 2-3 sigma extremes on the top, they're exiting their long positions, guys. Most of the people would be exiting because it depends what time frame buyers sellers they are. But whatever you grabbed, most people are going to exit at that level. And you guys have seen it happen over and over. Look at the 2 sig buys. I mean, they buy it at 1 sig, it drives it up, retests, right? They will sell and buy at 2-3 sigs. Whether you have fear or greed feelings, they will just do it. And sometimes you will see it and you'll just watch them do it without you because you didn't trust it. And a lot of you guys struggle for that, right? It's like, man, look at this dump. I don't think they're going to buy it. Like, look here. Pop, huge dump, reclaim a first sig, and then go long, right? Isn't that the setup? But a lot of you guys will be, scared, and you're like, oh my God, they can't do that. Well, they will do that, right? They will do that probably 9 out of 10 times. You lose a level, reclaim it, you're going to go in that direction. So it's important that you guys understand the trend you're in, and your trend, whether it's lower highs and lower lows like we are in now. But also, if you think about the CPOC, if you're trading above the CPOC, your targets will be the first sig, second sig, and you're looking for any opportunity, if you're, a scalper, is to catch the bounce that will drive you to the next sig, and so on. I personally don't buy a lot between 2 and 3 sig. I'm never a buyer there. I'm waiting to become a short position, and then I'll buy out, kind of leaps like I did for SPY and Qs. I'll buy some puts, longer time frames. Okay.
Shorty, can I ask you a question?
Mm-hmm.
Between the 12, 13, and 14, that bounce of the first sig, is that what you called a failed breakdown?
Yeah, that's definitely a failed breakdown. They failed. They trapped a
Yeah.
lot of shorts, and they reclaimed it. As soon as they reclaimed this is pretty much how the 80% rule works. You fail, you go below the value area, and then especially if it's a gap down, and then you reclaim it. Well, now you have the opportunity to go. When you're trading between the SIGs like this, if they lose a SIG and they regain it, high chance that you go to the CPOC. This is going to be the magnet all the time. And you see here, they lost it, they came back. Here, they reclaimed it, they went back to the first SIG. So anytime it's lost and reclaimed, your reclaims are your retests.
What's the 80% rule in a nutshell for the newbies?
We'll cover it here, so just stick around.
Okay. Gotcha.
Here shortly.
Okay.
So I've put down some ideas, and I'll explain to it on the next slide. But if you're in a bracketed market, right? If you're consolidating, whatever the consolidation period, guys, market can consolidate on 1 minute, 2 minutes, 10, 30. It just depends what you want to trade. You guys have seen me grab a FVP, fixed volume profile, on consolidation piece, and I would say the 2 sigmas here, and we would reject to a penny on it. And then we would go to the POC, and that's, if you're a scalper, that's your paradise. That's your bread and butter. You shorted a 2 sigma and you get out of the POC, right? And those are the plays that you have to determine based on what type of trader you are, right? Let's say if you break the first sigma and you're retesting, you can go long if that's your type, to go long on a sigma retest to go to the 2 sigma. Sure, but you better start thinking about closing some long positions as you arrive at 2, 3 sigmas. At least that's what I do. If you break inside the first standard deviation from the top, meaning you break the first sigma to the top, then you lose it. Well, now I'm turning a little bit bearish because you could not auction higher. Now you're auctioning again lower. I would be shorting that first sig and drive it to the POC or the mean. CPOC on a longer consolidation. The longer the consolidation, guys, the more important it is for sentiment. I mean, it really, really is, like, hey, are we bullish or bearish? Above CPOC, simply start targeting, the first sig, second sig, and third sig if you're long from CPOC, and your position size should be decreasing long as you're approaching the upper standard deviations. Does that make sense? Can everybody visualize it?
Yes.
Okay. If you're below the POC, and if you're below and you try to come up, so you lost the CPOC and you're trying to come up again, that's not a bad short opportunity, because if you went from the balance at CPOC where there's a lot of volume, and those, remember, at CPOC there's a lot of buyers and sellers, hence it is CPOC. If that area was imbalanced and then it creates an imbalance, let's say lower on the retest, that's a good short. Because if there's so much power to move it lower from that level, those people will be defending there. And you're just going based on probabilities that they're going to be there again, and you jump in with them. Okay. And then everything I said would be true for opposite, right? If you're above, you break above and retest, that's your goal long, because now you're protecting, right? Okay. So what I did here, I tried to kind of give you guys some scenarios how really the price action happens, right? So you see them here, made a previous high, they're consolidating here, then they break the high, they swept the liquidity on this side, and then they're coming. Here's your previous higher low, they break it, but at the same time, they're retesting the 2 sig. So they broke above it. Let's say they rejected the 3 sig. They come here. This is a good short opportunity, right? You have, you had a higher high. Now this will be your lower high right at this point. You made change your character. You guys see the line here? I drew, I don't know if it's visible to everyone, but they made a lower low here with a nice close, and they are coming back to your 2 sig. This is a pretty good short. Your first sig is your first target, and this is your second target. Why is the second target a must exit? Does anyone know?
Likely gonna bounce.
Anyone else?
POC is the point where if you're coming from the top, becomes your target, because below that sentiment is that when you short the POC itself.
That's correct.
It's,
so most of the time, if you exploded, go ahead.
maybe it's going to be the support as well until it proven otherwise.
That's correct. So if this is the price, right? If we popped from this price and we went higher, well, this is their first retest here. So if you shorted here, you for sure want to get out here, because people that shorted here are going to be covering here. And these people that went long here, that drove the price higher, what are they going to do? They're going to protect that level. So it's a double. It's you covering the short and buying, and it's them going long at that level, and it really can create like a trampoline effect. So you want to be closing as you're approaching this. You don't want to wait till the tap, because you can get a nasty candle off of that, and then you're no longer going to be profitable. But does everybody understand this short setup? But this is if this is what you trade between the 2 sig and first sig, that's a good setup. The same setup would be available for the first sig. If they come here, what about this? Does everybody understand this? Just read it all and let me know.
Seems like this
Why are we going long on the second touch on the COC hedge instead of the previous touch on the CPOC?
Good question. Anyone can answer that?
Change of structure.
To change the structure. I'm teaching you that you don't just have to necessarily buy the POC. Unless you're using tape, unless you're using some kind of absorption model where you're looking at the footprints, this is my absorption model. This is me knowing if they change the behavior of the market. If here, you have a higher high, lower low, lower high, lower low, then you have a lower high, you have a higher low, what happens here?
A higher high.
They put in a higher high, they change the behavior. So that means that demand is absorbing all the selling, and now the sentiment's shifting. So I will play the retest of that and go long instead of going blindly here. Because if you went long here, right here, and that's why I put this here. If you went long here and you get stopped out, and then it goes higher, you'd be like, man, I got stopped out. And this is, you guys have heard me say, this is a typical market maker pattern. And it's also in the Vyckoff, right? It's called what?
Something with 5?
What would this be called?
Spring.
It's a spring.
Free.
They catch you below. They make you think we're going lower. They grab your liquidity here. They grab everything you have as a stop loss to sell because they need it. They need it to go higher. They grab it and then you're stopped out and then the market proceeds. So instead of doing this, what I'm suggesting for some of you, and the reason why I added this slide, because I've seen some of you struggle. I'm not going to name them, any of you guys, but I've seen you buy it and it's like, damn it, they stopped me out. And then you see them go higher. So here I'm adding you a little bit of confirmation, whether it's 3 minute, 5 minute, whatever your time frame is. I'm not going to tell you what to trade. You need to define that based on your personality and the way you are. I'm different than you guys, right? I trade more aggressively, sometimes not. Depends, what the market's telling me. If you're opening inside the value area from the previous day, I'm not so aggressive. Right? I'm expecting the tops and bottoms to do, but I'm not aggressive in between. So I'll be aggressive on the bottoms till proven, like somebody said, otherwise. But here, if I see, hey, we're trending down, I don't want to time the bottoms, guys. You should not time the bottoms. You should not time the tops. You need some structural change for you to say, yes, now the demand is becoming overwhelmingly strong for the supply, and it's more aggressive than suppliers are willing to sell. We just did an auction. Why don't you guys buy my bill for 110?
Not the worth it.
Yeah, we
Okay.
want to make sure there's demand. We don't want to go in blind.
Exactly. That's exactly what the change of character does for you. We want to know that there's other people involved in this price discovery. I mean, nobody bid $110 for a $100 bill. I was going to give it to you. I was going to mail you $100 for 110. But nobody was willing to do that. So if there's no buyers, but right out of the bet, people offer 90 for it, right? So from 90 to 100, there was opportunities to buy it, right? What if you bought it at 93 and somebody was trying to buy at 97? Would you sell it?
Yes.
I will not.
I,
Because the
I,
value is
I
at
would.
I mean,
100.
you can, but there's just not enough.
I would, but as we approach the 100, I would make sure that I am, not there. With the $100 bill, you know the value because it's a perceived value of the whole, I guess, world, right? But when you have the stock, that's why we use the sigmas and, standard deviations and accumulations, is to know where's the perceived value. If AMD is approaching, 100 level that we talked about, and last time we were there, we sold off, what is the perceived value on that one? Well, it's not 110, it's below 100. So what am I going to do? I'm just going to short AMD below it, buy time and short it. Why did we go along a Z-scaler? Well, at least why did I go along? I don't know who went along.
Because of the perceived value.
Yeah,
It's worth
perceived,
more than 100.
yeah, perceived value is more than 100. Every time we came to 100, there was at least 10% gain on the stock. I think at least 15 times now.
I had a quick question on the change of structure will also be on the same time frame where I am trading. If it's 2 minutes, 2 minutes, 5 minutes, 5 minutes, right?
Yeah,
It's not like
whatever.
a.
Yeah.
Okay.
I mean, you want to be aware, right? So if you're in a 4-hour, let's say down channel, if you're lower highs, lower lows on 4 hours, well, you want to know where the previous lower low and lower high are in 4 hours. But if you're trading the micros in between, you could do that. But just remember, you're against a big trend, right? If you're taking out a 4-hour change of character, right? And you're trading 1 minute on that, well, you're a little bit of, a little bit of imbalance, right? You're trading a 4-hour structure on a 1 minute. That's probably not the best ratio. See what I'm saying? Like you need more confirmation than 1 minute up candle above it. Does that make sense?
Yeah.
Usually,
Definitely.
intraday, if I'm trading intraday, I'm on 3 or 5. But that's just me, right? That's my preference. Some people use 2, I don't know. I like 10 minutes for, spotting reversals. I like 10 minutes for structures as well. 10 minutes is my favorite for SVs. So that's how I look at it. But does this chart make sense to everyone now?
Yes, Shorty. Just a quick question, Shorty. On the reversals or whatever the breakout thing that the triangles where it is breaking out, you exactly look for like a confirmation on a maybe 10 minutes candle. Is that what you are saying? Trend reversal or change of structure on 10 minutes?
I'll look at for volume, stopping volume on 10 minutes to see if I'm catching. Remember, volume is going to confirm the movements. if I'm looking for, let's say, this change of character right here, we were popping above. I'm gonna look as they're going up. I want to see them come here, and I want to see them print, whether it's a pin bar, some kind of candle that confirms the volume is there, that they're defending, and then break of that candle, you can go along right there. Or if there was an imbalance candle, remember how we showed the naked trading, if there was a balance and then a large imbalance candle to break this previous lower high,
Yeah.
I'm gonna go on a retest of that candle. Remember the previous candle, you grab the high and low unless the wick is larger. You grab that and then you go long from there. Friday, I drew some candle and I went back on yesterday. Actually, I looked at it and I was like, holy shit, it worked. I drew a candle where there was an imbalance and I left it before I logged off. I don't know if anyone recalls this. It was quick. And I said, look at this, imbalance where we literally came back to that level like 5 times and bounced. I'll show you guys later when we get to the charts. Last piece, when you have the CPOC to bottom sigmas, how do you play it? It's again the same. You sweep the liquidity, right? They broke below the CPOC now. And what I was trying to do is bring the series back. You go here, and kind of give you the whole flow and the movement. Hopefully you guys are able to see it. But here's your liquidity. You swept it here. You made higher highs. You see how here you made a higher high and you took out the first sig, but then what happened? Somebody said it earlier. It regained it, but it failed. So this
No
is
demand.
well, there's no demand. There's no auction. Why don't you guys bet on $100 higher? There's no value.
No value.
There's no value for you to buy $100 bill when you can go to a bank and get it for $100. It's worth $100. So same here. They auction higher, they fail, they come back to a point. Anytime you're shorting first sig, what's your first target? Be careful how you answer this. It's a trap question.
You shouldn't be shorting first sig. Or
Retest of.
I'm sorry. I thought you meant on the bottom. My bad.
Oh, yeah. Here, if I'm shorting, what's my exit?
The
CPOC.
CPOC.
DLC.
Before,
What
I would not reach EPOC because it could violently jump. So about 80% to
Yeah.
it.
The range of the CPOC. Yeah.
That's a good answer. Also, make sure you pay attention if there are shelves that are fairly large in between POC and Sigma. Remember, between Sigma first and POC, that's 68% of the volume. You might have some shelves that are fairly large. It doesn't mean it's going from first sig to POC directly. It could stop at this gap protection. So you have to be aware of those things. If you're grabbing short here and you're grabbing it here, just know that there's a potential for a bounce. So unless you're managing the position in such a way that this is your entry and this is your exit here, then that's okay. But if you're one of those traders where you move the trailing, well, you have to be careful and know where those shelves are, right? There's a high potential for a bounce. There's a higher probability in the run, if you lose this, that you're going to go to the POC, then go to the 2 sig and break above and go to this 2 sig again. But it depends what kind of trader you are. You have to pay attention to the shelves. Okay. And you don't want to take a profit. I told him if you're shorting 40.69, you don't want your exit to be 4.153 and a quarter. Like somebody said, you want to get out just a tad bit earlier. You want to catch the momentum, especially if you're trading options. You want to sell into the strength of selling, not once you see a candle and boom. When I was trading Friday, I was not bored, but I was missing trading, and I would trade from the phone in the car, and I'm seeing them coming up to a level, and I'm like, oh crap, let me close my short because I know I can expect buyers to be there. And that's just the like I'm closing it. Yes, I'm losing maybe $30 extra on a contract, but now my contract didn't go from, let's say, I don't know what I tried. I took a few trades Friday. If I took a contract, let's say at 2.5 here, and it's at 3.9 here, I'm okay if I don't sell it at 4.4 here, guys. I know it's stupid, but that's okay. That contract went from 2.5 to almost 1.2 on this bounce. So you have to realize that, you know, when the buyers come in, especially when you talk about late in the day on 0DTs, those contracts, man, you have to be, and I know some of you guys cry about, oh, contract went from 2 to 55 and I sold it at 7. Yeah, go cry some more. You made $500 clicking buttons. If you want to make $500, I'm planning on putting some sod down and some sprinklers in the front yard. I'll pay you 500 so you can do all that work. Don't be an idiot. I mean, $500 in the split of minutes is a lot of money per, you know, hour. Don't put too much on your plate. You need to make thousands in a day. Start off aiming for $30, $40 and let it grow, let it grow, let it grow. Play the levels, learn the system. Once your account gets bigger, you increase a little bit of portion size. Now it's no longer hundreds, it's 500 a day. Well, once your account's much bigger, you play the same idea and same system. It's just that your buying power is a little bit higher, so you increase a tad bit. You dial it up a little bit more. Now instead of 500, it's 1500. As long as your process and what you're doing is valid, and the probabilities of your setups are higher on winning than losing. That's what you're aiming for by learning. Your goal is not money at the moment. Okay. Did these scenarios help you guys? I have 2 more to add. If you guys find value, I'll add them. If you guys don't find value, I won't add them.
Yes, please add.
Yeah.
Yes,
Definitely.
Yeah,
please.
they help out.
So I'll add, there's more here, right? There's the SIGs, the 2, 3, and SIGs on the bottom. I'll add those as well. And then we'll cover some real scenarios with candles. I just want to give you guys a visual with this line graph. Okay. Value area tips and tricks. I'm not going to go through every one of these, but you guys need to read them, right? This is bread and butter of understanding and taking the bias out of your trading. And I think a lot of you guys that the struggle with that, right, is, you know, flipping, right? Sometimes I'm long and 2 seconds later, what do you hear me saying? Hey, I'm short here. I personally don't care. I care that, you know, my probabilities are on point and that they work, right? That they work in my favor. I don't, you know, from long-term perspective, do I care if market goes up? Yeah, a little bit. But when I'm trading intraday, I just don't care. I care that it reacts to the levels that I have. And, you know, these points here, especially, you know, the first 3 points, if you're new to volume profile, you really, really want to understand that, right? The last point that we added on this slide's been happening a lot, and that's why I added it, right? You guys have seen where we have a D-shaped volume profile, and then at 3:30, we go from below the value area all the way to the high of the day, right?
Shorty, sorry, when you say value area, if the stock price opens above the value area, that's POC, that's POC, the value area, you mean?
No. So your POC is the components of your volume profile, right? So if you look here, right, the yellow line is like the point of control, right? You see that?
Yeah.
You have the value area, right, would be somewhere around. So it'd probably be the purple, let's say the purple box is your value area. That's where 68% of the volume happens. Value area is your standard deviations. So if you think about this, your value area, the original or the main value area is the 68.2. So it's basically between this line and this line. That's your value area. Your POC is the mean. So if I'm opening above PD POC, meaning I'm opening above the mean or the threshold there, that's fairly bullish. That tells me all the volume that happened, we're still above it. If you're opening above value area high of the previous day, that means you're opening above the 68% of where the volume occurred. That's fairly bullish. And you're getting into the next slides here, so let me get there. So these are the 4 types that we kind of care about, right? So you have opening outside the previous day value area, but inside the range. The inside range means high of the day and a low of the day of the previous day, okay? And then you have opening outside the PD value area, but outside the range, meaning if you're gapping up, of course, if you're gapping up above the previous range, that means you're going to be outside the value area altogether. that's that's fairly bullish, and you just need continuation. And in that case, your PDH and PDL play a huge role. And then when you open within within the PD value area, right? There's two scenarios inside. If you're opening within PD value area but slightly above, the previous POC, you're slightly bullish. Most likely you test the previous day value area high, and most likely you'll reject it there, right? And then if you're opening within PD value area but you reject it, what does that look like, right? That means you're gonna break that value area high or low within the first hour. If you do it, that's a rejection. So let's kind of go into it. If you're opening within the PD value area and then you're accepting, so within hours and within the first hour and you don't break the balance, the previous day value area, high and low, that means, most likely you're accepting the PD value area high. Usually you buy the bottom, sell the tops. Isn't that what happened on Friday?
Yeah.
Did I give you guys that on the watch list the night before? That's probably what was going to happen.
Yep.
And it was just basically off the volume profiles. I looked at it and I said, hey, this is a 20-point range. They're really stuck now. And they played the tops and they played the bottoms. And I think on Friday it worked like 5 times. Short the tops, buy the bottoms, and pretty much killed every time. So if you're opening within the value area and your initial balance, the first hour in a market, does not break that, that means you're accepting that value area from the day prior. Okay.
Shorty, question for you. I know you mentioned something about because I think we had news on Friday, and you said if the news didn't break the tops or the bottoms, then most likely those levels would continue to be respected. Were you talking about previous day high and low, or just a value area high and low?
Previous day value area high and low, and that's where you can also use the 2 sig. It's a good question to know if they break the extreme of the value area, maybe they want to go higher, right? But usually it's the value area. I would say 99% of the time it's the value area. Because if they really wanted to test the PDH and PDL, that means you have to break the value area, right?
Yeah.
Good question. Does everybody, can you guys visualize this?
Yeah.
Would it help if I give you guys a chart with no candlesticks and give you a visual? Like just 2 boxes and a drawn price action? Would that be more helpful than a real example?
Yeah.
Yeah, Shorty.
Okay,
Yeah,
I'll
sure.
draw that. So here's an example with the box, right? Here's your previous day value area, right? And then you open, you're kind of lost it, I would say, if this is our open, and then you regained it. And then what did you do the rest of the day? Here's your high of previous day here. Here's your low. And every time they came back, they stayed in within the range. Right? So that means they're accepting the area here. They're not really going outside. They're happy trading here till, news or whatever that happens drives it above and below. Okay. This is the same example, it's just that you're rejecting. So if within the first hour balance and you see a strong push to the upside or downside, this is a little bit more riskier, but it's also more rewarding, right? So when you're trading with the value areas, and you guys saw it, right, on Friday, you have to be fairly quick on taking profits. And I truly mean this. Some of you guys want to, when you open inside PD value area and within first hour, you're expecting the value, initial balance and the PDs, value area high and low from previous day, you guys are expecting runs of 300-400%. In those type of days, you're looking for quick entries and exits multiple times. If I'm buying the top, selling the bottoms, and buying the bottom, selling the tops, the range is most likely tight because you've been playing ping pong in between. That means they're going to get there. So instead of holding for a long time that contract, you buy the top, short the top, sell the bottom, buy the bottom, sell the tops. So instead of catching one play for 200%, now you caught 2 for 100. Does that make sense? Or if you hold, you catch 2 for 0 or 1 for 0 or negative. Does that make sense? Can you guys conceptualize that?
Yes, sir.
Yes.
Okay.
Yeah, Shorty.
So here's this one here, right? So this is your visual rejection. We open with the value area, but then we test the bottom of the value area and we found, seems like a lot of aggressive buyers shown by the wicks. So, and you guys see the tail of this profile on the bottom is really, really skinny. That means there was other time frame buyers coming in and really sweeping the price. And then you see, if you compare, if you look here, I know this is an outdated example, but you see the POC did a single candle, whatever time frame I'm on, probably 30 minutes, did a single candle close below?
No.
No. So the sentiment's fairly bullish, right? That they're not really spending much time below the PD POC. So once they break that, they give you a little crappy retest of, previous day high here. If you guys draw a line here, they gave you a nice little retest here, and then they explored price much higher. And this is what I mean by your risk to reward increases a little bit, right? First, you have to know where's the target, where's it going to. Then you really need some kind of, confirmation. Yes, this is the value that we want higher. And sometimes you might not get a real one where it comes back higher and comes back retest. That means the market has momentum behind it, right? And it's fairly aggressive buyers coming in. So if that's the case, if you see these candles like you did here on the bottom and you see them POCs not breaking, that means there's a lot of aggressiveness coming. Once they break this higher, you see them give you a quick little retest. If you catch it, great. You're on the train. If not, then the train's leaving without you, and this is where the retail starts buying, and then you see what happens. And then if you read this bullet, it matches to what we talked about, the value area tips and tricks. If you truly read the PowerPoint and understand it, you'll see a lot of interdependencies between slides. Okay. If
I
you're
feel.
go ahead.
Oh gosh, I feel like such a fool. It's Jet here. I'm your classic retail trader, so it's quite eye-opening and embarrassing actually. But thank you.
Well, I think the more you understand this, the more you will find yourself where you were and where you want to be in terms of a chart and buying, right? And especially,
Yeah.
On intraday stuff, on day stuff, people, the greed enters your mind and emotions get skewed. And that's how they get you guys. Oh, we're not going to retest. And then what do you know? Out of nowhere, you got a retest to the level where you wanted to buy, but you bought it now because you didn't want to miss it. And then you're down on the play. And even if it goes up to higher, you still might be down because you're swimming against the current now. And, the theta and all the Greeks are against you. If you're trading options, right? Futures, maybe not, but most of you guys plays options, and, the timing in options is very important. And in futures, timing is important as well, but there's no theta, right? It doesn't kill you as the time deteriorates, right? So it's a little less painful. You just have to nail the direction. Opening outside the value area but within the range, hopefully you guys can visualize that. You're stuck between the extremes of the 68% and the PDH or PDL, right? That's what this is. If this happens, you will most likely have the same range as previous day when you guys can back test this. It's not like, this is 100% accurate, but more times than not, the range of that day is going to be similar to the previous day. This is not one of those where you can trade it easily, but from this scenario, I would say you can generate some really nice 80% rules. If you're an 80% trader, I think this is the one you're waiting for, where you open outside the value area, but then, you're within the range and then you fail the extreme, whether it's value area high or low, you get back inside. That's your bread and butter. This is your favorite type of day to notice when it happens. Okay. If you're new to volume profile trading, this might be a hard one for you to trade until you learn the 80% rule and to trust it. Once you do, then it becomes fairly easy. Okay. And any questions on this one?
Sure. Yeah. A question on that. So you're saying basically, I guess 80% rule has a better chance of playing out if you open outside of value area, but like within the previous day's range, than if you were to open up completely out of the range altogether.
No, I did not say that. That the highest probability of 80% playing out is when you open outside the range and then you come back inside. That sentiment's very strong for a downside.
Okay, if you were like at the top,
That's
if you were
correct.
opening
So
above previous day value
that's
area.
correct. If you
Okay.
open above outside VA and outside the range, and then you fall back inside the VA high, that's a high probability 80% playing out.
Got you. Yeah.
Or
If you
or
read the second bullet to the last, if you open above PDVA and then dip inside the PD area, bounce the middle of it, like PD POC or 50% of the PD range, chances increase that most likely will test PD value area high again.
or inverse
On-
for upside, retest previous
correct.
day value area low, and then
That's correct.
go long.
Yep.
You want to base outside and cross back above, retest, go long.
That's correct.
The best trade ever.
And you will find bread and butter that works for you. And you just, the goal is to find it. And some of you, I know a few people that really trade 80% pretty much all day. I know Burnside did that till he got comfortable, and that's all he does. I mean, he does it even now. He notices them fairly quickly. And if you guys look, I mean, you have to know, how's the VA compared to the previous day, right? If you're opening outside, how is it forming within the first hour? Are we overlapping higher or overlapping lower? Okay. So this is, we're not in balance since, once you open outside, you're really not in balance there. Okay. Let's see. This is the one that you're talking about, Island. Opening outside of range. If you open outside of previous day range, meaning you broke the PDH and the PDL, that means it has shifted. How do you determine if the price is accepted in this scenario?
If the price is accepted, we're in the value area of the previous day.
Careful, it's a trick question.
Previous day value area high or the range top.
Okay, somebody else.
Well, like I'm not sure if this is what you're looking for, but if we open
Well,
up,
let me ask you differently. I want you to understand. If you're opening outside of range, that means you're opening outside of the value area, correct? Everybody can agree with that.
by range, do you mean outside of the high and the low, or outside of the
The
value?
ranges are high and low of the day.
Okay.
If you're opening outside of the, let's say we're opening above PDH, what is my acceptance on this type of day?
A retest of a previous day high and bounces from that and goes higher.
That's correct. If it fails, you're setting up for a really, really nice return and a shift to the mean. And the shift to the mean will probably be the previous day value area low. That's where the 80% rule plays out the best. Okay, that's what you were asking earlier. I was just kind of leading you into this one.
Got you. Thank you.
Yeah. Mm-hmm.
When you say 80%, it happens 80% of the time, Shorty?
It works 80% of the time.
Works 80% of the time.
Correct. And we'll get there.
We're still not there. Okay,
Yeah,
got
we're
it.
not there. As long as price does not go back inside the previous day range, market has accepted the breakout, up or down, right? It can be bearish or bullish. Can everybody visualize this?
Yep.
Anyone struggling to visualize it? Okay. Dual tape, I think I've covered this. This is not something you guys should be, you should not look like, oh my God, dual tape, let me go long. It's something to notice, right? If the market is going down, right, and at one point it's just no longer going down, and let's say, if you're watching flow, but you see people and participants are very short and really bearish, what do you think happens? Well, the market makers, the dealers, will basically close their shorts. And if I remove the selling, or remember the first tape where it was exhaustion and imbalance, if I remove my selling orders, what happens?
May go up because there's lesser selling pressure.
Yeah, exactly. It's just gonna go up because there's not much there in between. So it's just gonna go to the next level. And you guys have heard me probably say it live, man. It just looks like they're gonna step out here. And think about it. Market makers make money when? Or the dealers, when do they make money?
And there's a lot of activity.
Yeah. Activity drives profit for them. So if on the bottom, the price is not generating activity, how do I get you guys involved into the market? I either push price to the previous level where there was activity, or I push it lower dependent on their, hedging and inventory, right?
Yeah, get it to the jump in. Get you to buy or sell.
And back in the day, this was, on the floor, if they had, like in Chicago, on the commodities market, if everybody's, let's say, in a sugar pit, and you see people leaving sugar pit and you're still short, oh man, you learn a lesson real quick. As that pit empties and you're the last one shorting there, you're the one holding the candle for the rest of the guys. They leave. And you're short and the market is just gonna pop. And if those people shift and they go to, let's say, corn, and there's a large order that comes in, the price moves up, all those people that were short on sugar now are going to be long corn. And what happens to the person that's last short sugar? He gets screwed, or she, because they already left. They closed their positions on short side, so now it's going to be easier to go higher. And that's pretty much what the dual tape does. Okay, so somebody asked, just kind of bring up this slide. Your point of control is here. I want to make sure everybody understands. Your first value area high and value area low that we care about, standard, is your first standard deviation here. Your second standard deviation, second sigma, is there. Your third sigma that we have is there. So this kind of represents the bell curve shifted and the skews, right? This is a normal standard bell curve. This is your mean, which is your POC. This is your first standard deviation. This is your second. And here's your third here. Does that make sense? Can everybody relate to this slide?
Yes.
Okay. Jet, does this make sense?
Yes.
Okay. So where's the value area?
Between VH and VAL.
Yep. That's your real value area. This is where 68% of the volume occurred. Okay. Fixed profiles, we won't go there. Do we need to cover this? I think you guys are up to speed on this by now. Is anyone that's not up to speed on this? Okay. This breaks down even more, adds all the components to it, not with the picture, right? Point, low, high, and then VH, VAL. So yeah, should be okay with that. We covered low volume nodes, high volume nodes. This is your initial balance, high and low. Some of you guys might not be familiar with that. So market has, they have two sets of sentiments based on the trader types and ways back. First one was the opening range, right? The opening range is your 30 minutes. Your balance, initial balance, is an hour long. It's from 9:30 to 10:30. You want to mark the high and the low of the first hour. And then there's some rules. There's some rules that we have. If I say if the 3 5-minute candles close above IBH, after 10:30 Eastern, then there's 88% chance that the low of the day was set. And of course, same is true for opposite. If we close a couple of candles, let's say 3 5-minute candles below IBL, then the high of the day has been set, and that gives you probabilities for shorting, right? And it gives you a little bit more statistical edge. If the balance is narrow, and this is what I warn you guys, if the initial price, if the initial balance is tight, and we've seen this couple of weeks now, most likely it will expand at some point during the day. We will most likely have a trend day after this occurs. If it's wide, that means there's a lot of participants and they're happy trading. Most likely you're not going to break the highs and low of the days if the initial balance is wide. So if the initial balance is wide, you should get an idea. You're not going to have a trend day. Most likely you're going to stay within. Can you guys visualize that?
Yeah.
Okay. Okay. Does everybody understand the last bullet? If the price opens above PD value area, right? And initial balance is formed higher than PD value area, would you guys be bullish or bearish?
Bullish.
Yeah.
Bullish.
That's something, to pay attention to when you're trading when the day opens. These are your kind of like checklists. Where are we? Are we above PD POC? Yes. Are we above? Is the value area stacking higher, lower, or overlap? Inside, outside? And then how's the initial balance compared to previous day value area? If it's making higher highs and higher lows, then you're leaning a little bit bullish because it's making a new value area that's higher than the previous one. Okay. So
Sorry, IBH and IBL, the 10:30 a.m. candle, you don't account for 10:30, as in you account for 10:25 a.m. 5-minute candle, right?
I'll look at 1-minute candles in that market.
So you will not look at 10:30 a.m. 1-minute candle. You will look at the last candle is 10:29.
I include 10:30.
You include 10:30. That's what I wanted to check. Thanks.
Yep. And this is just like an example how I market, so you guys can at least get in the habit. And you guys will see me when I trade live. I usually set it before, and then I shift it as we get to the time frame to see. Does that make sense? Okay. We get into the date types. So the D-shaped, most of you guys should be familiar with these if you read through the PowerPoint at all. Markets are in balance, and this usually leads to a typical day. The close of typical day can give you a hint, right? If we have a typical day where it's a D shape and you're closing on the upper side, let's say close to value area high, that means that the buyers are, the people are seeming a little bit more bullish than bearish. Those are called the extreme of the D shape, right? That means, there's buyers, but they're leaning a little bit slightly bullish compare if they close above POC and closer to value area high. If they close below POC on the opposite side, they're leaning a little bit bearish. And you want to know when these D shapes are super tight and the value areas are super tight and we're not breaking them, you can note, hey, this is most likely going to be a sideways day, and you kind of want to avoid trading that. Okay. And this is where we do what when you're trading a typical day?
For the top, by the bottom.
That's correct. And where's your exit
Until it
points?
doesn't work no more.
If I'm shorting value area high, where do I get out?
POC.
POC.
Good. POC. If
Before
it breaks
POC.
The POC, yeah, well, slightly before. If it breaks POC, then you can short again if it gives you a nice entry and drive it to the low. At the low, you don't want to be shorting. Don't be an idiot. Don't short the bottoms on the typical days. Okay. If you grab the high and lows, this is just a tip of a typical day, and the POC is higher than the 50%. Just note that. Note that, hey, the POC should be usually aligned at 50%, like right on the dot within 2 points, 3 points less down, plus minus 3. If it's a big difference and POC is higher than the 50%, that tends to lead a little bit more bullish sentiment. It's just a hint, not something you live by, something to pay attention to in back of your thinking when you're trading. P-shaped, where should these occur? Who can summarize this? Anyone can put this in a summary?
Short cover rally.
Not always. When is it a short cover rally? Who knows?
Downtrend.
Yeah, when you're in a downtrend and you have a P-shape out of nowhere, that's a short cover rally. What else can you say, Sunflower, about this?
They didn't find value lower, so they auctioned higher and created a new point of control.
That's correct. So you should not, this is a really good P-shape here. You should not have a lot of high volume nodes as you're going from the bottom to the top. You want to account for the time being spent on the bottom. It should be quick. They are aggressive. They found no value on the bottom. They're saying, hey, this should be higher here. Then they come to a POC, they accumulate, right? If you're playing the retests of the P-shapes, where should you do it?
After it breaks, the PLC comes back down and then retest.
Anyone else?
HVN below the
You want to be playing the HVNs on P-shapes. Remember how we said earlier when I was talking, if they're going higher and they have an accumulation and they pop from the accumulation and continue aggressively higher, well, that high volume node is the one that you want to be targeting. Right here, they're just accumulating, selling for the next move. But if they give you opportunity to buy a discount, you buy it at the high volume node where they accumulated. Whether it's this one here with the value area low, which is a good one, or this one. Right here, they gave you pop higher, came back quickly. But now if they come back to this one here, which they did, that's a pretty good one. And when you see this in a downtrend, right, that's the one that you kind of pay attention to. When you're running multiple Ps together in an uptrend healthy market, that's normal. It's just aggressive buyers going higher. Just go check, go back and replay, check 2020, and you'll see something. Well, how many we had. And let's flip. What if they're, this is your how to trade it, right? What about B-shaped? Lowercase b.
Shouldn't it be the same kind of?
Same concept, exactly same concept. If you have a B shape, and we did recently in an uptrend, what did I say about it? You guys recall this? It happened last week. We had a B shape up top in the middle of that consolidation of 18 days. We said, even though it's not a true uptrend, it's a mini uptrend that we had from the 2 sigma. We went up, the bulls left. They exit the area, they rejected, and the bulls are no longer there. The smart bulls are no longer there. Now they're looking for value to drop so they can buy at the bottom of the value. If you guys think about Anna Cooling in her book, it says, as we, they fulfill their warehouses on the bottom, as they get to the top, they're going to look on every run up to empty out the warehouse a little bit. And then at one point, they're going to manipulate the price that it looks like we're going higher. And if you go to current ES, sessions, if we break above the 2-3 sigma, what do you think they're doing there? Think they're buying a 3 sig, 2 sig on consolidation? No.
Is that what she said? Is that what she calls a test?
Yeah, they tested, they saw, they got idiots buying higher, and then they exited their. I mean, if I could sell that $100, $110 bill, I would.
Yeah.
Right. And I'm not calling any of you guys idiots, but I would sell it. Right. So if you can sell it higher, sure, if they're willing to test it. But then as you empty out the warehouse, if I don't have any more $100 bills, what do I have to do?
You need to lower the price so you can buy them cheaper.
Yeah, I need to make the dollar sound horrible or the stock. I need to bring the value down. So once it becomes to a desirable value, like first sig or second sig, third sig extreme, I'll go buy it and then I'm gonna tell you that the world's ending. Why would I tell you that?
So you sell
So you,
and I buy.
yeah, you sell.
Fear.
I want to create fear on the bottom so I don't have competition buying the dollars from you guys. I want to get you guys away from the dollar. I want the dollar to myself. Therefore, in the news, magically somehow as we reach the bottom, there's going to be a lot of bad news. Retail is shitless scared, and what happens? The price goes up. Then the good news start popping up, right? And it happens a lot. Just go back and find some news website where you watch and just look at what starts happening at major support and resistance levels. It's almost like we're in a matrix, seriously. As you reach the top, some news start coming up. Somehow the rockets start flying, well, not catching rockets, but real rockets start flying across countries. And everybody gets a little scared. And what do people start doing at the top? I'm sorry, at the bottom, people start freaking out. It's like, oh my God, the World War III is coming. Let me sell, let me sell. And these guys that sold at the top, they're like, oh man, it's working. Thank you guys. We're gonna buy the dollar, $70, and then we're gonna create a little bit of more greed as we go up. We're gonna sell it to you back to 100, and then comes the retail. I'm not gonna call him. He has 100,000 followers on Twitter. He said that there was a bull flag on Tesla. I actually responded to his tweet and I said, "You're crazy, dude."
Can I take a guess at who it is?
No.
Because I know who it is.
I responded to him. I was like, dude, there's a really bearish volume anomaly here. There's two of them. One was Jake. We know him. He's a useless trader.
But there is another one as well? I didn't know that.
Oh, there's another one. I responded to him. And he has supposedly a really good rate of trading. And I think he's a good trader, but he trades retail patterns. So sometimes it doesn't hit.
Maybe he had a big position in Tesla and he was just getting confirmation bias.
Yeah. Well, I responded. He said, "I really don't know what you mean." I said, "Okay, it's not." And then I tweeted that this was not the level to buy Tesla. I don't know if anyone recalls. It was not a level to be buying
Yeah,
Tesla.
the HBN.
Yeah. So that's understanding, hey, there was a B shape in an uptrend on Tesla and a strong rejection at 209. And you think it's a bull flag? You don't understand the market auction theory. They're selling. They're emptying out the fucking warehouse. And here you are looking for a bull flag to go higher. Like, I'm not sure how they survive in the market. Maybe because he has, 10,000 members in his Discord. But
I want to watch the first season again.
You do want to watch first season again?
I do. I want to see. I want to catch up. Like it was like so long ago. I don't remember him.
Oh, got it.
this person, DJ or Drew. So does the B shape make sense a little bit, or you guys understand it?
Yeah, makes sense.
Does the bottom point make sense? Understand the bottom point. Does everybody understand the bottom?
Yeah.
Is that like a retest?
No, this is the break of the trend. So if in a B shape, the price closes above the 50% of the high and to the low, there's potential that new buyers stepped in and they close the price higher, and there's a chance we will not continue lower.
Oh, I didn't see closes above. Okay.
Yeah, and it's same if I flip this, it would be the same for P shape. If you're in a P shape and the price closes below the 50%, there's a scenario, I believe, a couple of days back. Okay, we'll get to it live. I identified this level for you guys multiple times on a P shape. Do you guys recall it? Like a lot of times but I'll point it out when we go to the live screen so you guys can see it. I identified that POC and I said, hey, this is going to be the bread and butter of it. It was a weird P-shaped profile. It had a lot of volume nodes on the bottom building up, and I said it has to be fixed, the structure, and they fixed it. And that POC became pivotal for up or down. We'll get to it.
Shorty, when you say fix the structure, so that fix the structure is that from single print you make it double print. Is that what it means or something else?
Well, a profile that's built on a day and it has a poor structure has a lot of single prints in between. Those single prints have to be tested. They have to be fixed. The market likes, balance.
Understood.
So they will come back and they will fix the structure of those. Like,
Other question. Sorry. Go ahead.
like in here, if I was on, let's say, TPO and there's a lot of single prints in here, that's a poor structure. They will come back and revisit that.
Okay. But these single prints at the extreme, like which we call tails, those don't have to be fixed, right? Because those are probably Sigma 3 and beyond, and
Correct.
that's
But
where
they
they
play
should
a
be.
huge role. If you have a tail on the top, like you do here, and there's a poor structure there, and the bulls are not able to take out that poor structure, what does that tell you?
Strong high.
It's a strong high. That means there's not enough buyers there. Not enough strong buyers to take that level out. That's really bearish. And people don't understand that.
One
If
last
the
thing.
weak spots can be taken out, top or bottom, if it's a tail on the bottom and the bears can't take it out, that means there was a strong buyer there. And it's a strong low. They need to slice through it in order to go lower. It's a poor structure and you can't take it out. That something's wrong. Okay.
Be it a B shape, P shape,
You
a
sound like
D
you read a
shape.
book. You're
Yeah.
asking the right question. Which book did you read? Seidlmeier?
Yes, I did.
Okay, I see. Yeah, okay.
The other one is that these profiles which we have, the small b, the capital B, D, or P, all of these are good with regards to playing these based on HVNs or where you are. But essentially, the sentiment is that not corresponding to POC always, as in P shape or a B shape. If you're opening above or below POC, your sentiment should be bullish or bearish because we are opening above POC or below.
You're talking about prior there always, right?
Yes, always prior.
Yes, correct.
Okay, thank you.
Yeah. So in this case, I know it's a bad. I don't know when it happened, what happened, where I grabbed it from. Here's your POC. Of course, you open, let's say, below it. Then you regained it, you reject it and regained it, but you're not able to hold it. Next time you come back to it, look what happens. You gained it, lost, retest, you short, right? And you're not able to close above it. That leads to a lot more bear sentiment. Especially the 50% for gauging the level from one day to another. If this day closed, let's say somewhere here, 50%, the odds of this going lower really, really decrease. Okay, good questions. I can tell that you've done some research.
I was doing this mind over market and other stuff.
Good. No, I think we beat this to death on a B shape. These are good days, right? B shapes are pretty good because you can catch some nice, especially on options. When you enter these skinny bellies, they tend to be one of my favorites on options because they really slush or flush through to the bottom of it. When you're in a B shape, you most likely should pretty much trade within the range. It's not normal for them to break top or bottom. If they do break the top or the bottom, it's a really strong sentiment statement. If you're in a B shape and you go to the bottom, you accumulate, and then you break the top, that's a really, really, really strong sentiment to the bull side. Does that make sense?
Yes.
And same is true for the opposite. So if you accumulate at the bottom, you go to the top, and that top accumulates, and then it breaks the bottom. That's a really strong bear sentiment.
That's
Okay, but you
double
can,
distribution day, right?
yeah, it's a double distro, and you can usually play, beer kind of like a ping pong in between, right? You buy the tops and the bottoms, knowing that these nodes should not be broken.
Gotcha.
Okay. they're good days to play because they do have I would say, a pretty good range in these type of days. So this is just an example how you can play it. Probably not the best one. SR flips. So if you're new, this is fairly important concept from the sentiment, and it's important because of others. It's not important because of you. It's important because when the sentiment shifts, people notice it, right? Retail notices, and then the big boys also notice it. And if the SR flips are in confluence with the volume nodes, like high volume nodes or POCs at those levels, they become very, very deadly. And usually that's what I kind of search for on smaller time frames. And you guys, I think on Friday I mentioned it. Like, why is this level important on SPX? It was it? I'm not sure. It was 4130 on SPX. You guys recall that? I asked why was SPX 4130 important, and it was mainly because the flip.
Yeah.
And it also happens to be like a POC. So to me, when I was shorting the tops, I was getting the hell out of that short as we approached that level. And I said, we got to short. If you want to short SPX, if you missed it, it's 4130. It has to break and hold and retest. Otherwise, you're not shorting this. So the longer the flip, the 4-hour daily weekly, that's mainly for your swings. Can you play those intraday? Yeah, but you have to be somewhat quicker on your profits so you don't catch the rejections. And I'd say intraday is your 1 hour, 30, 15 minutes. And you just want to pay attention to that. Don't be a perfectionist where one line has to hit perfectly. You can draw a little rectangle around the area, right? The wicks, the top bottoms, and create a zone for it, right? There's no really levels that are important. I think there's demands and supplies that are important. So this is kind of what it looks like. You have the support, you break it. Here's your resistance. Some people, if you want to short here, that's your style. Sure, short it. I like to short it here on the retest because it gives me a little bit more confluence and it gives me an exit. I know the previous low, I can exit there and be okay. And here, that would have worked out in this scenario. Especially if the POC, let's say if I grabbed it from a cumulative POC, and this was a nice POC here, a lot of volume was there, man, it just makes that probability of that trade working out in my favor so much more. Okay. So here's another scenarios where, your resistance becomes support. And then I added the piece of information here, right? Usually when we are consolidating in a range, that range gets repeated to the upside, and that's your target. So if you're trading naked, charts, not naked as a person, but if you're accumulating here and the range is 12 points, your target is also 12 points from the retest here. So from 118 to 120 would be your target. Does that make sense?
Yeah.
Okay. Candles. So a lot of, I'm not even going to go into it. I honestly don't. I wish Twitter would check some of this shit that people post. People post candle types, more bullish, more bearish types, and thousands of people follow and they thank the person for posting the candles, and yet that candle that he and the formations that he posted are wrong. You have to be careful what you absorb, from outside world without really proving that it's correct. Like whether it's teachings or the news, just do some research, please. Don't just pick up. Even if you don't trust me, do some research. A lot of my stuff that I'm teaching you guys, I'm doing it from the market. I'm doing it from the experience. A lot of stuff that I have, when I recommended Dale, for beginners to read volume profile, it's an introduction to volume profile. He really doesn't go into depth of the volume profiles, but it gives you enough to understand it, right? There's more to volume profiles, the dependencies, the types, the traps, and all of that is next level, but at least have some backing to whatever you're looking. So on the candles, whenever you see like these, let's say pin bars, if you haven't read the book, The Pivot Boss, you could definitely read it, and he has a lot of good stuff on hammers and whatever you want to call these candles, inverse or regular hammer. He has a lot of information on there. I know Drew read it, but there's statistical edge to a candle being formed. What percent is body? What percent is tail? And way back, people used to calculate that. Like, hey, the hammer printed today on a daily. Let me see if it's aligned properly. is the body, like, I don't know, 1/5 of the whole wick, or is it, what's the top wick? Is it this much? So they know, and like how many times occurred before, how many times did it work out? And that's all they had. They didn't have these computers to give them these analysis. They had to do this shit manually. Therefore, it computes a result, and that's kind of what I like. I like statistics and I like probabilities. So when you look at these candles, like, what do they mean, right? There's bearish and there's bullish pin bars. I don't necessarily segregate them into, yes, there's candles that are more bullish and bearish, but don't lose the denominator bullish and bearish. Don't add losing power, adding power to candles, because it creates confusion. If you look at for pin bars as support and resistance levels, and you short on the breaks of the lows or the highs of these, right? And you guys hear me looking for stopping volume. Let's say we're going down and I'm looking for a stopping volume. I want the volume to pick up, but I want the body to be looking kind of like this candle. I go long on the break of this candle, and I can put a stop loss below this one, because I know there's people that are going to protect me. They're going to fight for me to stay in the play. That's how I see it, right? And then when you think about it from in a cooling book, here, this is your lower wick example. You open, the selling pressure comes in, right? And then what do you have? You have an exhaustion, the low is set, then you have the buyers come in and you get a candle, let's say a gravestone doji in this case here, right? Open, sell, low, buying, and this is where you're looking for stopping volume, and then you look for long, let's say above this candle. This is the formation of the wick and understanding of the candle. The same is true for the opposite, right? If you have a top wick, you open, you have the buying pressure, you have the high, then you have a lot of selling pressure. Just pay attention to this tomorrow morning when you look at it in the morning for the first 10 minutes. You're going to get, on 1 minute, you're going to get at least 2-3 candles that look like this. And you can short it below, scalp it, and you might be done for the day. Just paying attention to the candles and the pressures of buying and selling. Is there times where this will be, this is at the top and then they fake it out and they go along? Yeah, that's why you have stop loss. Like, we don't know where the market's going to go, and neither does the market, right? It's based on the masses of the people and which way they bid. So here's an example. This is straight from Dale's book, right? So, you had a pin bar here. We created a balance. If you grab a volume profile in this little area, probably POC will be right on the blue line. You dump and you're coming back to a short level, and that's a pretty good short. You're joining the sellers on a retest here if you didn't catch this one. Okay. So if you're thinking about volume profile and everything, we kind of covered, right? So we jumped over those volume profile types, whether it's fixed, session, or visible range volume profile. But in essence, they all yield to the same result. When you're using the volume accumulation setup, it's basically you're grabbing volume profile and you're looking to the points in a chart where we consolidated, where candles overlapped. And if from overlap, they created an imbalance, meaning an explosion, like a big candle, and it pops down or up, that's the area you're looking for a retest. But the key point, what you're trying to find here, if we're trending higher, if you're making higher highs and higher lows on, let's say, 1 hour, and we popped from that area, you're not looking to short that trend, guys. This is where a lot of you guys fail. If I'm making higher highs, right, if I'm going up, 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 I'm looking for a zone that accumulated to play a retest to go long. Especially if it's a beginning like of a nice trend where we had a change of character, you had a nice balance here, you're looking to take that long. A lot of you guys want to short the trends up, and then when the flip of the character happens where it's actually flipping bearish, you guys want to go immediately long. So, and just consider this accumulation setup has to be in agreement which way we're going. Okay. Does that make sense?
Yeah.
This is a really, really good setup. So the 70 short that we took was based off this setup. Okay, so that was this one. This is the value area examples, right? So we've talked about this where we, if you look at PD value area highs, you had the 4 examples where we said the opening and how we open in the relationship to the range and the previous day value area. This is how you can play, and then a note, the acceptance or rejections, right? Here you try to go and kind of find the new value area high, but you're failing. You fall back inside. This is your short entry. This right here is your short entry, first target, second target, and you're done. What would this be categorized as in terms of the setups that we play? What is this right here? What would this be? So somebody asked, can I explain it? Does anyone know what this would lead to?
80%.
This is your 80% jet. So if this is our previous day value area, we popped above it, then you fail inside. Once you fail inside previous day value area, there's an 80% chance that you're gonna hit this value area high and go to the opposite extreme to the value area low. Does that make sense?
Yeah.
Jetter, make sense? He's gone. I think we confused him. This is, a rejection of PD value area. It means you spiked above, you didn't find much value, you fall back inside, and they yield to 80%. Well, what is this one?
I'm just looking for new value.
This is where they accumulated, right? And they popped above. It's a 1-2, right? You break above. Here, let's say you made a higher high, you completely took the sweep here. You're coming back. This is your potential long retest. You break nicely above, you take out the previous highs, you come back. This is your long opportunity. This is meaning that they're looking for new value area, right? They had like a little spring here, they pop, POC, retest, go long. Okay. This is a really powerful, if I'm thinking in terms of longs, this is one of my favorite longs, and this lately has been happening a lot. If you guys go back and retest it, this is a really, really, really good, been really paying well, where they lose the value area and then they reclaim it. They've been running really aggressively this setup here, where they lose it, they come and retest the PD value area, and why does it work? What did they do in the news and PR when we are here? They create fear. You guys are so scared to go long, and then they reclaim that value area low, and that's a go long level. And most people are still looking to short, but there's an 80% chance you're going to go to the top now. And if you don't know that, you get burnt a little bit, right? Does that make sense? You guys, I would print some of these out and put it above your screens if you can't visualize it. This is just a very, this was on a weekly chart on Oxy where we had the accumulation. You had a nice accumulation, then you had a markup. They drove it really, really high. And at that time, we were long at this level here. Okay. On the flip side, I skipped the slide. This was one of the, this was on SPY. If you guys look at it, we popped above this POC, and this is what they like to do. The only reason why I added this slide here, you see that we accumulated here really nicely. We popped, and you see the wicks here, absorptions happening, and what do they do? Well, they're testing your stop loss, right? And they're going from one opposite to the second opposite here. Even though you had a nice accumulation at dump here, they trapped all the shorters here. They went to the top of value area high. If you know about the values and extremes, you can definitely short once this sentiment shifted here. You could have shorted it right here, or the volume accumulation setup. Somebody's trading futures. What the hell are you trading? Or maybe you're replaying something. If you guys look here, this was the POC. We popped above it. Then what happens here? From this POC, this was a fake trap long. They went to the value area high to empty. Remember, if I can sell my $100 bill at 120, should I sell it at 100 if I know there's people willing to buy it at 120?
No.
No, I should wait for you guys to buy it at 120. Then I'll sell it. And then once we dip here below this POC, it really becomes a good shorting opportunity. This is from volume accumulation setup on bigger any time frames. This is my A+ setup. You accumulate, you break above, you trap, and then you come back. So if I lost this one here, I won't lose this one. Probably 99% chance it's going to work out. And you see them. This is your POC. I mean, this is a long, lot of data here. Look how well that worked. You lost this, I would call it cumulative POC here, and look where we're headed. To the value area low. So you went from the extreme to the extreme. You went from the extreme to the extreme. And that's why value areas are, I would say, probably the most important thing to know.
That took some time there, right, Shorty?
Oh yeah, this is your swing setup. This is from 2018, I believe. No, I forgot. I mean, this was a long period, man. I think a couple of months, April to October. So yeah.
Oh, okay. Yeah.
6 months.
Big boy stuff.
Here's the 80% rule, right? So 80% says that if you break in, let's say, let me just kind of cover this, bring back to here. When you open outside but within the range, that's a really good probability that will happen. A better probability happens, you open outside the range, outside this, and then you fall back inside the value area high. Let's say this was a bullish outside. Then you fall inside, that's where your 80% have a higher probability of working out. Can you guys visualize that, or I need to add a slide for it? So if this was our PD value area high, we popped above it. Let's say this is our range top. If we open above it, then you fall back inside. This is 80% chance that you're going to go from here to here. And pretty much that's what happens. Okay. I would say if you're not familiar, spend some time on this slide and the next slide here on 80% rule. It's fairly simple. Is there anyone that doesn't understand this? I'll go in detail, but okay, good. One point on this is the unexplored area. If the area has been explored, meaning the value area has been up and down, the 80 chance rule is no longer important, right? If we lost PD value area low, let's say we drop below it, then we regain it and we go up, then we go break the PD value area high, and then we fall back inside. That's no longer 80% rule, guys. It's been played out. It's washed out, and you necessarily don't want to wait for that 80% rule. Okay. Settings and parameters. I'm not gonna go through this. You guys can use this. Just don't ask me on chat. Hey, what is the setting? It tells me you didn't read this. You have to put some understanding into it and playing with it, right? This is what I use. Doesn't mean it's in a stone. If you find something better, sure, use it, right? But this is the settings that you want to use on TV and TOS. I would say read this to understand it, right? If you're a day trade profile, if you're a day trader, you want to use the daily sessions and previous day sessions, and you want to use daily VWAP. If you're a swing trader, you want to be using maybe weekly profiles or even monthly profiles. Depends how much time do you have and what type of trader you are. If you have 10 minutes in front of a screen, maybe because you have other obligations, then there's no reason for you to be using daily sessions to determine the sentiment. You want to be using higher time frames to be swing trader. Okay. That's why sometimes, especially when we're consolidating like this, when we, from March 30th to now, we're in a really nice consolidation. Then that's where I draw the composites. You identify the, yeah.
Oh, sorry. I thought you were done for a second there. Somebody's asking how you decide how long your visual range volume profile should be.
Well, that's the art, right? I mean,
Mhm.
if I'm on the dailies, like if you go on the daily candles right now, you're gonna see us not really having any follow through, and a lot of candles overlap, right? For me, that's I would draw a volume profile on that, right? Either fixed or visible range. I prefer fixed. I will grab the start and the end current consolidation. I would draw my first sigmas, and I would know where the volume nodes are, right? Where's your third, second, first sig? Where's your CPOC? And then I would determine the sentiment of that range alone and trade there till it breaks. If you're a day trader, you can do that. Maybe you can use a previous day session or 2-3 days, like on the 41 or 4070 rejection or 4170. I don't know which one it was. We use the 3-day balance to find that POC. And there was logic to it. Anytime we came to that level, we rejected it. We, even if you went above it, you quickly went below it. So that told me that in that range, there's some importance, and I just wanted to find what that level was, and it came out to be 4070 and a half. So it's really just looking at the price action and how it reacts to the levels, and then you kind of draw your POCs or your fixed volume profile to see what is under the hood. So where's the volume coming in, where are the big boys, where's majority of the volume, what's the profile shape look like, and all these pieces that we just covered through the session. You're thinking about, hey, volume profile, even composite is shaping to be D shape, and we're on the top again. Let's say we were at the top again and we came back to the bottom, and that's where they accumulated. And now they're driving it back to the top of the shape that, that's setting up for a bear short right at the top. So those things, you have to start putting together the knowledge of volume profile and kind of everything we put together to make that work. You can't just say, from this point to this point, this is going to work. You have to use logic in what we teach and the, and in the Discord, kind of put the pieces of the puzzle together. Okay. This, I'm going to skim through it. I do expect you guys to read that book, so I'm not going to spend a lot of time spoon feeding you. When I call out stopping volumes and anomalies, it's basically what Anna Cooling, described in her book. And there's stuff in her book besides this, right? It's the ideas of how they manipulate the market, how they, switch your feelings, and how you guys react to it. I strongly, strongly urge you guys to read the book, buy the book, physical book, and just invest some time into reading it. Okay, so I'm not going to spend too much time on that, but you guys can definitely read this on your own. And I do suggest you guys read the book. Trading in the Zone is another book that if you haven't read it and you're struggling, I suggest that you don't you don't trade for a week, and you really understand what the book is trying to tell you, right? If you've never read it, I think you really should stop trading and read it. I took some of my favorite quotes and I put it in this PowerPoint that were important to me, and they're deeper than when they on the paper, right? It's really understanding how it happens and what happens to you. The way I think about stuff, when it happens, if it's happening to you or is it happening for you? There's a difference in the meaning of those statements, right? Maybe it's happening to you, but it's happening actually for you, and it's going to make you a better trader as long as you're taking those teachings and applying them properly. So a lot of you, and I know Jet, you're you're on the in between right now as a trader, but you have to understand your weaknesses. Why did you buy where you bought it? Did it make sense? Were you buying against the trend? Were you buying with the big boys or selling with the big boys? Were you playing against them? Those things play a role. And if the things keep happening to you, maybe they're giving you a message. Maybe they're happening for a reason to you and for you, not to you. So you have to understand the behavior of it, the mental aspect of it, right? And then the 5, fundamental truths on trading. This is important. Pretty much anything can happen. If you flip a coin, right? You don't know when and where, but you don't need to know what's going to happen next to make money in the stock market. You just need to predict, not react, not predict to the levels. If you're focused, and you guys know by now, I get really aggravated when you guys freak out about one trade that didn't work out. Who gives a fucking shit about one single trade that you took and it didn't work out. Your measure as a trader is that over time is your probabilities and your setup and your style working. A single trade does not define you as a trader. You need a continuous number of trades. If continuously you're taking trades and they're not working, well, then you need to really sit down and look over and be like, hey, what the fuck am I doing wrong? You need to be logical about it. But if you're winning, your setups are there, but you're still negative, then it's not your setups, it's your mindset and your profit and your risk management that you need to be tweaking, right? So you guys cannot stop looking at one trade and freaking out over it, right? Iman's been really better about it, right? He's, he would be really negative. Now he writes really good in Orb Profits. If you guys read his feedback, it's actually thought process that he's in. And sometimes I just tweak it a little bit for him to see if he catches what I'm trying to tell him. If I tell him what to do every time, I don't know how many of you guys have kids, but if a kid's struggling with something and I resolve it for him every time, and then he goes in the real world, what do you expect my kid to do?
Fail.
He's gonna fail. Most of the time he's gonna fail. I'm not here to, I don't do call outs. You guys see me trading live and I will say, hi, I'm short and long, but the goal is for you guys to understand why I went long or short. Does it work every time? No. Do I lose money on trades? Yes. But do I make more money than I lose? Yes. I will cut if it doesn't work out, it didn't work against me. It didn't work in my favor or the odds were not there and move on. But you guys, you get, emotional. Seth pissed me off on Thursday, right? He lost the trade. He wanted to end the day green. It's okay to have a red day. As long as you understand why you had a red day and you can fix it tomorrow, that's okay. But you don't.
I took my red day on Friday.
Yeah. And did I text you?
Oh yeah.
Yeah, I texted Drew. I didn't want him to fall the emotional trap. You have to understand why you're red. And there's days where I just don't feel like trading. And I don't know if you guys get it, but I just don't feel like trading. I don't want to. If you have any challenge that you don't feel like don't fucking trade. And when you guys, I'm like, yeah, I'll go live, and I just don't feel it, guy. I don't know how to explain it. It's really hard to. I just don't feel it. I'm not gonna trade. I'd rather do something else.
I know what you mean, Shorty. Sometimes I wake up and I just don't feel it.
Yeah, if you don't feel it, don't fucking get up. Don't even get on the screen. Otherwise, you're gonna be taking setups you shouldn't take, and you're not gonna be logical. And that's logical in terms of your setups, not logical in terms of what market's doing. You trade your setups logically, not the market. Market's not logical, right? It's efficient, but I don't know. It's not a yeah.
Those are the days you lose money, man.
Yep.
Every single time.
This is a fairly powerful quote, right? If all of you started switching to probabilities instead of win or lose, I think you guys would gain a little bit more money in your trades. There's really no right or wrong. Your setups, if you're using volume profile, if it's a volume accumulation setup, if it's trading sigmas, if you're in a consolidating market, you're shorting the tops, buying the bottoms, that's a setup that we take. If you're trading 80% rule, that's a setup that you take. We have an edge based on what the market has done a million times before, and we are trading that setup. I'm not wrong for doing it. It's the odds were not in my favor when it happened. There was other characters in the market or something that did not line up to take the same trade. You have to get away from, I lost trade, I lost this. No, change the wording and behavior to your probabilities, and you will also feel a little bit happier about it as well mentally. And the more you down yourself, I'm not going to call out any names, jokes aside, when you constantly down yourself and belittle yourself as a trader, what do you think happens? Believe it or not, in every joke, there's some truth.
Yep. You start to believe the negative, and that's what happens. Is
you're gonna lose that confidence, man. This is a confidence game. I've seen people call plays, and I'm like, dude, what the fuck are you doing? Like, why would you go there? And dude's like ecstatic and confident, and it works out in his favor, and he gets out shortly after. If he didn't get out, he would have been clapped. But it worked out. His crazy ass confidence worked out. He was quick. His setup was there, whatever he saw. Maybe I didn't see it, but that's okay. He saw it. He had the confidence. I was teaching my son, soccer out of nowhere. I don't force him to play soccer. I played for a long time. And I tell my wife, I'm like, hey, we went to a game. I was like, man, he scored 12 goals. Like, I was like, I really don't know what the fuck's going on with this child. I wrote him off as a soccer player. I didn't tell him that, but I was like, hey, maybe it's not something that, he's going to be very good at. Well, out of nowhere, he became the best player in the soccer team. He's practicing every day. We have a soccer field in the backyard. He goes out, practices. And I just encourage. I was like, see what happens. I mean, you practice a little bit, and it's compounding. I was like, you go on the soccer field, and everybody's like, hey, pass the ball to you, and you finish it, and you do this, and I'm just kind of providing more support for him than making him do it. And same with you guys. I mean, sometimes I'll call you out. Hey, that was great. That was a good job. And the reason why I do that is for you guys to continue doing the things that work. But if you're constantly negative and you're no longer thinking positive, how can I help you when you're not helping yourself? Right? So you guys have to put some effort into it, right? If you have the negative mindset and living trade to trade, yeah, you got to forget about that. You got to think about long run. If trading was as easy as everyone thinks it is, we would all be traders. This is literally like a mini college degree you're getting. You got to pass the test. You got to pass the exams. You got to understand that, the content that you're being given in a way that makes sense to you as well. If it doesn't, that's where you ask questions. You have the opportunity to schedule 101s. But you have to put effort in it, right? I'm not going to spoon feed you everything that you need to do. And it might not even click, even if I did. And when you do take plays that are not your plays, you're reiterating your bad behavior, believe it or not. You will never, I guarantee you, ever become a successful trader if you're grabbing somebody else's plays. First, it's going to deepen the habit of not being responsible and accepting the risk. And if you can't do that, you're never going to succeed. I don't give a fuck who you are. It's never going to work.
So true.
And this is another one, right? This goes fairly deep. Does anyone know who Ibrahimovic is? Like Zlatan Ibrahimovic? Does anyone know who he is?
No.
Yes.
Okay, I'll post a link so you guys can see this guy's mindset when he plays soccer. When he came to US, he played in top clubs in Europe. He came to US in LA Galaxy. They had an interview, and they're like, well, you compare to this guy and to this player and to this, but it's like, how come you don't compare yourself to these people, but others do? His simple answer is like, man, lions don't compare to normal people.
I saw the video.
He doesn't compare himself to. I mean, his confidence level is pretty high. And if you watch did anyone watch Ted Lasso? The latest season? You guys are boring. Do you know who Zava is in Ted Lasso?
Oh yeah, Zava.
It's Ibrahimovic. That's the Zava is Ibrahimovic in that show. And you see the confidence that he brings. I mean, just to give you guys an idea, the guy is very confident. He's 39 years old, plays in Italian soccer league. Most of us, if you're older than 40, it'd be good if you can catch 10,000 steps in a day. So the mindset's huge, right? And that team that he's in now, he's 40 years old, and that team, AC Milan in Italy, they're actually in semifinals of Champions League, a fairly young team. He just brought a shitload of confidence to them, where they really don't have a fear of making a mistake. They do it without thinking about the mistakes. And when you get to that level in trading, You're just taking a trade. Like Dumpsty, he struggles. He sees the setup, but he doesn't pull the trigger because his background, his personal, being an accountant, right? He's really risk averse. He doesn't pull the trigger, and then he sees it work in his favor, and then he beats up on himself for not working out. You cannot have a fear of trading your own setups. You got to get rid of it. And my favorite. A lot of people that I've seen, and some of you guys that I've had one-on-ones, like, yeah, man, I made a lot of money on AMC, and then I lost it all. I mean, even the broken clocks, right, twice, right? Even Jim Cramer nails them, surprisingly, right? And then all of a sudden, shit goes sideways. But to be a profitable trader, it really is about defining your setups, the probabilities, and then the mindset of it. All those people that win lotteries, most of them go broke. Because they don't know there's a difference between wealthy and rich. Wealthy people built it. The rich people, like let's say even a lottery, you're rich, most likely you're going to lose it because you don't know how to behave as a wealthy person.
Yeah, they don't invest anything. They just spend everything.
Well, not only that, but the habits are the important piece. He was broke because he probably had bad habits to begin with. A rich guy that built the wealth, he probably had good habits that got him there. If you go out and buy Gucci shoes and Lambos and this and that, one advice I got was when it's good times, prepare for the bad times. When it's bad times, prepare for the good times. And you can apply that many ways in the stock market as well. I mean, when the stock market was running 2020, and I would say to people, it's very easy to make money in the market now. You just buy calls and you're running. But during those times, you have to start thinking for the bad times. And even in the economy, right? If you have a business and your business is booming, you hedge and you protect your business by preparing for the bad times, the layoffs, the low, let's say you have a restaurant, people not eating out. You have to prepare for that and you have to strategically plan for it. And same way for trading, right? If you had a good day, and a few people I messaged last week, they had decent wins, right? I told them just take a Monday off. They won money on Friday. I messaged them. I was like, hey, just take a day off on Monday. Don't trade it. And the reason why is to protect those gains and to learn how to first pay yourself. Second, don't give it back. And third, it reiterates that you take out what you made. Now you have to start from zero again. A lot of you guys can grow from 1,000 to 2,000, but you can't go from 2,000 to 10,000 because you don't know how. You know how from technical standpoint, you don't know from mental standpoint. So until you take that 1,000 to 2,000 couple of times, you're not going to be very good at it. There's a person I worked with in this Discord, and he's taken 1,000, I believe, to 2,500 now 4 times. And I'll show you guys the conversation we had prior. He was almost borderline quitting. And now he became a standard. He just pays himself every week. And it's a big, 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 big mental deal when you can withdraw 1,000, 2,000, or let's say 500 weekly and pay yourself from trading. It's a really big mental change. Even if it's $50, try it and you'll see. You do a couple of weeks, now you feel like an employee of yourself. You're paying yourself by doing something you love. And then over time, it becomes a little bit more. Now he's starting with 1,500, no longer 1,000 on his account. He's increased a little bit. But hopefully you guys get the idea. This one here, I put this together based on kind of the way I see it. You guys really need to think about the risk when you're, if you're not willing to lose it to a certain percentage, right? Like if your stop loss is, let's say, risk to reward 3 to 1, I strongly suggest that you stick to that and you accept it. If you lose it, that's okay to lose, and you accept the loss, right? So, until you realize the risk that you're putting is yours to lose and you can lose it and you accept it, man, you're always gonna have a path where you're failing. You're gonna be, emotional pain. You're gonna blame the market. You're gonna trade with fear of losing. Once you get that, you're gonna continue kind of like taking trades and just repeating the cycle. And then you'll hit a couple of trades and then you'll be like, oh man, I understand it now. And you'll deposit more money. Then you go back to your old self and you just keep repeating the cycle.
I think in options it is more difficult because futures, you lose 3 points or 4 points. You can calculate how much
Exactly.
that is.
So
Options it is more difficult.
it is. It's much more difficult. And if trading futures is easier, then you should switch to futures. I trade futures when I've been trading futures, for a while now because the market's been not giving me, the freedom to trade as many options. And when I do see a setup that I like, I might go a little heavier on options typically, but lately it's been sizing down. Right. Okay, this is from Market Captain. We he posted it. I took it from him and I put it in a, I guess, readable format. You can definitely read it. It's more about FOMO, especially on the days where you have the large moves. Suggest you read it and understand it. Okay, and then we have some acronyms here. I started putting some stuff together. We're not gonna go into this just yet, but I'm putting some stuff together for you guys to start understanding the market profile. Okay. Any questions on today's lesson?
Not on today's lesson, but on TradingView, I saw either you were in process of developing that indicator or something which shows the market profile on TradingView itself. We don't have to go to TOS. Is that something that you can share at this point of time or no?
I can share, but it won't do anything for you if you don't understand it.
Mm-hmm.
So yeah.
Just helps us to give a little bit better perspective on prints and
I
all.
think what we can do this week sometime share it, and if I have time to put more slides, at least the basics of it, where you guys
So
can
you
at
have
least.
a question.
Sure.
When you talk about the 80% rule, sometimes 80% rule, you said that once it's played out, it no longer becomes valid. But there's been times where, we've had 80% rule play out a couple times, 3 times a day.
That's correct.
So that's possible.
It's possible, but the 80% is no longer 80%.
I got you. Okay. Thank you.
Okay. Any other question? Oh, somebody's trying to say something. Maybe I just don't hear it.
Are we going to look at the next week charts today, or is that not?
Yeah. No, we'll look at it. I'll schedule a session for later tonight to prepare, and we'll do the watch list and see how we open. But
awesome.
When you look at it, really much change.
No.
You are at the POC at 41.53 right now. So if you guys look at this, this is your consolidation here, right? So if you guys, so here's your March, call it from here if you want to grab this guy. Look where the POC is. So here's your POC. We can do the sigmas here quickly. So this is my first sigma here of this accumulation. We can quickly change that. Do you guys know how to change the templates, or you guys have no idea?
I do.
Yeah, we're good.
Okay.
I mean, I think that most people got it.
And this just helps me with the speed, right? So I don't have to replicate it. So now if I click on this and I change mine to 95, I know that's my second sigma there. I can change this guy here.
Right at the border.
And this would be my second sigma right here on the bottom. Then if I want the third, right? Here's your third sigma. So this is for people that struggle with sigmas. So now I have my 3 sigma here. Grab the wrong thing. Here's our 3 sig. So now you have these sigmas. I'll most of the time line them up because I'm OCD a little bit. If we go here, right? So now if you look at the price action, what's really happening? So your mean is at 41.53. So right now, we went to the extreme to the sigma. You failed at 2 sigma. You failed at 1 sigma. You went below it. You retested it, right? So the idea on how to play this, this is, I guess, freebie for people on YouTube, is when you're at the extremes of consolidation. We've been consolidating here for almost, what I would say, 18 days or whatever the number of days we got here. 24 days, I guess we've been consolidating. 22 days we've been consolidating here. So if you're consolidating there, the idea is to short the extremes at the top and go by at the bottom. You can play it multiple ways, right? I gave you a few ways earlier in the PowerPoint. You break below the sigma here. From 2 sigma, you could short it to first sigma, but in this case, if you like 9 points, you can definitely take that. The idea is once you break the first sigma here, there's high odds that you're going to be hitting POC. And look, what happened here, they came here and then boom, they came back. They came back again, they brought it back inside. So now if you guys think about, let's say 15-minute structures, the Friday was, I would say, fairly obvious what they were trying to do. We opened inside the value area and we pretty much stayed inside the value area. So basically we are currently accepting this value area here for the 2-day balance, right? This is our 2-day balance right now. Does that make sense? So now, if this is the break of structure, because you're consolidating here, you have, if you think about this, you have a higher high, lower high, lower high, lower high, and here you attempted to make a higher high, you didn't. You're making higher lows now. You guys see it, you have a low, you're making higher lows. So now, if you wanted to play this 41.62 to 72, once you break this level, higher chances you're going to most likely go here. I'm not looking necessarily to play the longs, even if you could, break 41.81 here, you could drive that 41.96, probably clear some liquidity there. I'm positioning myself for longer short opportunities as we reach the top. Like here, we added June puts for SPY. As we are reaching the tops, I'm looking for shorter opportunities. Once we break this POC, my sentiment switches, right? Right now, when we are running above here, it was retracements, and you see how, in this case, they popped about the first sig, they came back, retested, and you go long. Once you start losing these and you're making lower highs, and let's say the change of character, happens, let's say here, you break this, and now you're looking for, down, and then the CPOC would confirm that bias and that sentiment. So here, for instance, we're spending a lot of time below the POC here. I would check the volume from the bottom here. I would check to see what's really going on, right? So there's a lot of absorption here on this candle. We haven't had a candle or body candle close above this level here, 41.59. You guys see that? So if I'm paying attention to the price action, this is where a lot of volume came out at this level, and we haven't been able to close there 30 minutes higher. So if you close there here, I would be looking that we're going to go first sig here, 41.72. If you're able to break this, consolidation here, you have a nice triangle as well. People will call this ascending triangle outside of the Discord group. If you break this POC, would I short it right below this POC? Probably not. I would wait for this. Let me get a nice little break of the lows, right? You break this low and then give me a nice imbalanced candle here, and I'll find an entry here, probably 50% of it or something like that. And then even the retest of the POC, you need to break this here, let's say do this, and then you come, then, you could potentially do something like that and drive it. But right now, they're accepting this value area here. So the break, either one, is leading to the next big level. If you break to the upside, probably hit the first sig. If you break to the downside, most likely you hit 41.24. And then if you lose that, you're going here. And I would say this 2 sig is also a VPOC here. And then you have 40.80, which is a super important level. And then you have 40.42. So I would play those levels and such. You lose 40.80. There's a POC here. You lose that level, most likely you're headed 40.40. And then, if I wanted to check where are these buyers, right? How do we get there? So we got there from here, right? So I know there's a volume. If I was to grab all of this, there's going to be a big volume node here. And then obviously there's a big volume node right now where we're at 40.53. And then if you look here, right, once you lose this volume node 40.80, what happens? There's really not much till you get to this level here. And that's also the VPOC at 40.44. So that would be somewhere around here. And you'll be, if you're shorting from here, you're looking to close it here. If I was to figure out where do I go along, I would, draw a profile. You could use it this way. You would just have to extend this profile here so you can see it a little bit better, right? If I was looking for long from this level, right? So this is not a bad long here, like 40, 46, 40, 50. They're probably going to protect this area. But you see here, if we are able to push this to the bottom right here, let's say in this area, you see how big this volume node is, right? So it's almost looking like what shape?
Capital B.
Yeah, it looks like capital B. So if we lose this, there's a high chance that you're going to fly through this, and you're most likely going to go to this zone here. And from this zone, you're looking to go long. Does that make sense?
That's March POC as well, absolutely.
Yeah. So, and those are the confluence points that we look for, right? So now if I go on a daily, I'm just going to hide the SVP. Well, here's my daily picture, right? So I know, right, that there's a consolidation here. I can grab that FVP here and take a look at it. Basically, what I'm doing is I'm zooming in to see on this volume profile here. See what does it look like, right? So if I extend this, there's this POC, right? And we said our typical POC, if they break above it, and do what?
Lose it and then you short.
Lose it.
They go here. If they do this, then you know you can catch something like this.
Yeah.
Right. And then if you look here, this demand got tested here and it played out already, I would say. So here's this one. They came back. They already executed this one. Look, they came back, bounced perfectly, went higher. Now this supply at this point wasn't tested. We brought here down. Now you're seeing if this demand is going to make a higher high here on this one, right? And so far, I would say, not here. It has not, right? 4208 was not breached yet. So far, this supply is fairly aggressive compared to this demand. And then really, we haven't tested the bottom of this demand as well. We haven't been to this level of interest here, which is call it 3,700. So eventually, they're going to have to come here and make sure these people are going to defend.
A lot of V-Bucks on the way down too. A few.
So that's kind of how I'm looking at it. And if you can add whatever you use or whatever your confluence points are. Here's your channel here. If you're trading channels or care for them, I'll probably put it somewhere around here. So here's your channel here, nice channel, probably somewhere in the middle. You're stuck right now on that channel. Yeah. Yeah, you're stuck right below it here. So if they decide to go down, they could bring you back down, and there is accumulation here. So how can I check? I grab the low to the high, and I can see, what's going on. So if I was to draw that, I'll be able to know there's a protection right at 40.50. There's a protection.
Hmm.
Does that make sense?
Yeah.
And when I look at the profiles, and just kind of reiterate what we talked about earlier, we were consolidating earlier. You guys remember this profile shape? I think we beat up a lot on it. So this was your P shape, and you see the 41.72. When we came back to it, this was a really nice rejection here. And if you didn't know that, if you just grab this even here, look at this. Look at the node here. Let me just grab this one here. Look at this. It's right there, 68. And then if we grab multiple days like we did from here to here, it comes out to be perfect rejection. And that's what we were playing on Thursday. So we were somewhere around here, and this was our rejection. Now look, it came right on and it rejected it, right? That was the idea behind why there. And now if you pay attention here, right? So you have, guys, remember that lowercase b and where we close? We talked about it just moments ago. What does this say? Is this a low? This is almost like a B, but I would say in the regular trading hours, this would be a B shape. What does it tell you here?
We closed above the 50%.
Yeah, what does it mean? Most likely you're not going to continue lower. And what happened?
Bullish. Yeah.
We went lower, we went higher. So, and then if you go here, we talked about this profile here. We said that this profile was here, pretty nasty one. And anyone have an idea why? There's two components to it.
Price was not accepted higher, so it came back down like a strong reaction from the top. It's a B shape in an uptrend, like
What was
lowercase
at
b.
this level here? That's the second piece I'm looking for. What was at this level?
I think it was sigma 3, standard deviation 3.
Yeah, what else?
And
Let's bring-
February value area high, I guess. Yeah.
Yeah.
February
46
value, correct.
or something like that.
So now, if you reject the February value area high, you need to know where the low is. It's at 40.62.
Yeah.
So
That only if we clear Feb POC, right? Because that's still in the May, 4140 something.
if you check the weekly then and see if you're in balance, right? So here's your weekly. So you're in balance now on the weekly. Here's your balance. Low is 41.26. I would say, if you're able to lose, what is this level? 4100, most likely you're going to go, there's a VPOC of 4080 that we said it's super important.
Yeah.
Then you have another one here at 39.76, another weekly. So if you're to lose this POC here, you're going to quickly go probably to 4050. You have 4050 here, and then you have about 3980. But what do you notice about shapes on weeklies?
Was making higher highs, and then now it's a capital B shape at the top end. Sorry, small b.
Small b occurring at the top with us closing right below the POC.
Yeah. So that's
Bearish signal.
bearish.
That's your bearish on the weekly signal, and then on your daily, you had higher highs, then you had an overcapsulating value area high here. You rejected this off the whatever node here or liquidity. Then you have a really strong profile here. I would say 41.77 is fairly important. I would call it 80 probably. A little bit higher, somewhere around here. I would call it 80, just a zone here.
Mm-hmm.
I would call it something like this. If you're able to pop over this, probably a strong chance you test the highs. But for right now, you see the value area from here shifted down drastically, right? It wasn't even overlap. It was just a clear lower high, lower low, POC shifted. And now you have really compressing value areas. I mean, if you measure the value areas and you see, what is this, 16 points? Probably half of that. What is this telling you in terms of buyers and sellers?
The buyers are not willing to go any higher.
They're happy here.
Well, the price exploration is getting tighter. There's not
Right.
much,
Yeah.
there's not as many buyers and sellers here as there was
Mhm.
necessarily here. And if you look at these price areas, price value areas, right, they're not really wide.
Mm-hmm.
They're, 11, 10 points, but let's look when, on the bottom, let's say of this, where we were on the bottom of these, right? Where we started, look at the value areas there.
Yeah, they're much wider. Oh, that's
On
tight.
average, this day you can't count, this was Friday,
Yeah.
right? The value areas are just a tad bit wider here. Where the hell is that tool? Oh, there it goes. You see here, the value area is almost double digits most of the time. As we're getting to the top,
Yeah.
the value areas are getting tighter.
Real tight.
So the price discovery is getting tighter. They're not willing to go, they were willing to go lower, but they're not willing to price discover higher. Just like you guys didn't want to explore the price of $100 above, right?
Yeah.
So that should tell you something. Okay. So I think you're still in a very nice range. And in terms of profiles, here you spiked above it, but it was a very tight range. I mean, 7, 9, 9 points. You're really stuck at the moment, right? And you have this nice down channel now, lower highs, lower lows. Here you're almost attempting to make equal lows. So tomorrow might be a quick trend day or a gap down, gap up. Depends how we open, right? At 6. I would definitely use, I wouldn't care too much about this value area high here at the moment. I would care more about this one here. If they can break this one, either side, I think you can catch the next Sigma that's coming up or down. Or POC. But we'll cover it tonight and I'll schedule something for 8:30ish, 8:40, and we'll go and see how we open and put a plan together.
Awesome.
All right, guys.
Thanks a lot,
Hey,
Shorty.
before you get off, could I ask a quick question about the fixed range you drew earlier on the Sigma?
Yeah.
All right. So looks like you're still calculating Thursday, right? The 30th into your
That's correct.
into the Sigma, right?
That's
and that was an extremity that day, right? Which means news, right? And that extremity of news kind of was over around the 5th. And then after the 5th, we really haven't broken that 4,100-ish. So
This one here, or are you talking about?
yes, more for the Sigmas. And I'm on the 65 minute. I'm on the 65-minute chart.
Okay, I'm too. Yep.
Okay. So starting on the earlier the Sigma you drew that started Thursday the 30th, right?
Mm-hmm.
Okay. And if I take out the extremity of news, looks like we came down to 4,100. That was the 5th, right? And then we kind of have stayed in that area. So I was curious, why not redraw the Sigma, even though I understand that change of character happened on the 30th, but given that it looks like we based and claimed support, why not redraw the Sigma from one of those levels? Like if I redraw the Sigma from Monday.
Which date? Can you give me the date, please?
Sorry. All right, Monday the 10th. So if I redraw the Sigma from Monday the 10th, I notice that I now get, one sec, I gotta hide this one on my chart. All right, so if I redraw the sigma from Monday to 10th, and
My POC hasn't shifted, by the way.
yeah, the POC doesn't shift, but
Okay.
the 1, 2, and 3 shift,
Okay.
which was the difference, because I noticed when I drew it from Monday, you now get that consolidation from Monday to 10th through Thursday, kind of going into Wednesday. That's now falling on the 1 sigma. So I was just curious why still grab it from the larger time frames
Because
if
we
you're starting to
haven't
get tighter
broken that. We
consolidation.
haven't broken this low at all. I don't see a lower low being put into this range yet.
Right, but support is now shifted up, though, right?
It has, but this is still a relevant point. We haven't broken it to give me an insight that there won't be any buyers there, so I have to include their point and their volume. Well, for me, at least I do. Because right now on 2 sigma, we bounced right here off of it. We bounced off of 2 sigma here when I include this data. Otherwise, I'm ignoring that data where we bounced last time. If I use this way, it's nothing wrong grabbing this. Don't get me wrong. There's no right or you have to make logical sense, and you have sense in what you're saying. I'm not saying it's wrong. I just like if you're consolidating in a box and I go on a daily. Let's go on a daily. When did that consolidation start?
So if I'm consolidating in a box, it would have to be off of the lower would be Wednesday the 12th, starting at about 1900. Then we came back up Thursday about the 8th. So I would say and then we bounced up. So I would say in terms of a
I'm
box,
focused only on this range. I don't know where you are. Sorry, you lost me. I'm focused on that
I'm looking
piece
at
where I
April.
highlighted. Okay, good.
Oh, okay, sorry, I'm looking at my chart. All right, so you're all right. Let's probably say the 5th.
So you don't consider these candles consolidating here?
I could, but I also
No, I'm
like
not
to have a
asking you
retest.
if you could. I'm asking you
No,
from
I don't.
consolidation standpoint. This is not a consolidation candles here.
For me, no.
Why not? Anyone else see that this is not consolidation? An inside body inside the previous candle?
Yeah, I mean, you have an inside bar, and if you draw a box, it's going to be inside of that box on that consolidation.
It's clearly going sideways.
This is just sideways.
There's
You
no
have
higher.
equal lows.
Yeah.
Yeah, but if you're saying a consolidation, then I'm going to go to where that last wick touched on 40.96 up to 41.98.
41.96. This one?
I'm still going to go from there down 41.96 based off of what I'm seeing on the screen. If you said, where's my...
Yeah,
if you're
this is
saying
my
the area we're
consolidation.
consolidating within.
Yeah, but this, yeah, we got inside this area here, right? Where did we consolidate last time?
But so that's what I was saying, Shorty. If you draw the box from 40.96 to 41.98, those two candles are inside of that box.
Yeah, I mean, for me, this is the range here because the candles are overlap. I care about the overlap of the candles. This right here is not an overlap, let's say. This right here, this is not candles overlapping right here. This is stacking. This is imbalance from whatever this was, tiny range here. Now, I'm not seeing any directional moves here. I'm grabbing the consolidation. I'm not including this candle because you can, you don't have to. If I grab from here, I can definitely do that. But, you know, the way this tool works, I have to grab this one here to pick up this one. It's no wrong way to do it, rollout. I'm just grabbing the full spectrum, just like I was here. I mean,
Yeah, maybe I'm misinterpreting what you're saying because you're saying, are those two candles consolidation? And to me,
these
I
are
can't.
consolidating candles.
Okay.
The body of the candle never made a higher high. The body low of the candle never made a lower low. I mean, just from price action, I would want, if I want to see a non-consolidating candle, it needs to look like this. It needs to stack. I need to see this. And that's usually when you break the balances, you're seeing something like that. Here, I'm not seeing that. I mean, I have a candle here and then the body goes inside. Then here, this is an inside bar. This is an inside bar, inside, inside, inside. This is an outside bar compared to this one and this one. Outside, outside, and now you start the overlap. Just like here. Look at this area here. You had a break, a massive candle here, then another lower low, and then this one starts creeping in, this one starts creeping in. Then, you know, you see this candle here. This one here breaks that structure right here. And whatever they do, the back test, they came back and they put in a higher high. But this right here was a consolidation. This was the reason why this popped. So
So if we're on 65-minute candles, why am I taking two candles as consolidation? I guess that's what's throwing me off.
I'm looking. I'm basing this off the daily, guys.
Oh, I thought we were just talking about 65-minute candles earlier, so that's what I'm throwing off.
I'm
It's like,
looking
why
at
am I using
65
two?
minutes. I'm finding the levels on 65 minutes. I'm looking at this on a daily consolidation. I'm trying to find. We've been consolidating 20 days. I'm just going inside of it to zoom in with a microscope of 65 minutes. I'm looking at daily consolidation on 65 minutes. Does that make sense? Because if I go look at this on a daily, I mean, look at it. What the hell am I getting here? I mean, I'm getting these levels, right? But I want to see a little bit more clearly. So I zoom in. I want to see this. Now I'm able to see it, right? On 65 minutes. So there's a macro and a micro. Inside the accumulation, you're going to have higher highs on smaller time frames. That's how the price reaches the first, the third, the second, and third sigma. Here's your third sigma. Now here's my second. And they're getting there. From the bottom, they're getting to the top. Now you have higher high, lower high, lower high. I have to go on lower time frames to trade it. So I go look at it, mark it on 65 minutes. These are the levels that I care for. So this is my second sig, and now if I mark first sig, they are here. So 68% of the volume from this date to now happened inside the first sigma here. Then you have, like I mentioned, you have some shells in between. So I'm not sure if I'm trying to understand your point, but I don't know if I get it. I don't know if I lost you, but okay.
Hey, Shorty. I had
I'm
a
good.
question. I had a question earlier when you got to the SR flip slide. You spoke about the trade you took based off of the SPX when you got to 4130. If you don't mind, can you go over that? I didn't quite. Yeah, thank you.
Where was the? All right, what do you see here?
support changing into resistance, because I see some bounces and then some rejections.
Yep.
on
So
the-
here's your bounce, here's your loss, here's your consolidation, right? So they played this multiple times, this balancing where we had the value area highs and lows where you short it, and you short, you buy the tops. Then I was like, hey, I took this short when we broke this high. I took this short, I believe somewhere here. And as we're coming here, I was like, I'm getting out, because where are you? You made a higher high here, right? So you had lower lows, higher lows, higher lows, higher highs. Then you had, if you think about this level here, so this is the high, the previous high here, and look what you did. You broke that high there. Now you're coming back for a retest. I don't want to be short when I'm coming back to here. The
Okay, I see.
short was also like, if you count, here, you could have shorted this here at 335 for a little bit, but then they took that out really quick. This is fairly risky the last 30 minutes, what they can do. It's more about balancing and the delta positioning than anything else the last 30 minutes. So it's a little riskier. But does it make sense? This was a support that turned resistance, and I found this short. I get out here. I closed it here.
Okay, yeah, that makes sense. Thank you.
Because I didn't want to hold through the spike on 0 DTs. This can destroy you. This tiny little spike can, believe it or not, take 20-30% off on SPX.
Oh, okay.
But they did a really good job here, if you guys think about it. We had the gap. They fulfilled this gap completely. They played this over Wednesday really nice. Gap, finished the gap, then made a low and continued. So here you go. I would, SPX wise, I would watch these levels here. Lose 30, probably go to the 4100s, break 41, you go 4150, so 10 points each. Okay. All right, guys. Well, hopefully you guys had a good session. I'll schedule some for later on tonight just to see where we open and put the plan for the week. Hopefully you guys can take a look at it today and kind of understand a little bit more than you did yesterday, and start building up onto your knowledge of volume profile.
Thank you, Shorty.
All right, guys. Have a
Thank you,
good
Shorty.
one.
Thanks, Shorty.
Thanks so much, Shorty. Have a good day, everyone. See you guys.
Guys.